Okay, fantastic. Hi, everyone. Welcome to those of you who have already joined us in the session. I see lots of hellos and welcome messages coming in. Great to see so many of you already here with us, and a big thank you for joining us for this workshop. So, my name's Fiona Quinlan Wells from the UN SSE team, and it's a pleasure to be here with you today. So, let's kick things off. So, a big welcome to this half day of training on applying the IFRS Sustainability Disclosure Standards. As you'll see from the number of organisations presented on this slide, this programme is truly a collaborative effort. So, a heartfelt thanks to the IFRS Foundation, to the IFC and Bloomberg Philanthropies, as well as the Swiss government for their support in making this programme happen. And of course, a special thanks today to the team at Bursa Malaysia for hosting us in today's training session. I think it's perhaps the third or fourth time we've run the training with you, and we always have a very large audience with lots of great questions for us. So we're really looking forward to continuing that conversation in today's session. And of course, a big thank you as well to all of you as participants for taking the time out of your day to join us in the training as well. So to get us started today, I'm very pleased to let you know that we're joined by Julian Hashim, who is the Chief Regulatory Officer at Bursa Malaysia. So Julian's going to just give us a brief introduction and welcome to the session. So a big thanks, Julian, and the floor is yours.
Thank you, Fiona. Assalamu alaikum. Very good afternoon, distinguished speakers, esteemed participants. My name is Julian. And as I understand, the workshop has been oversubscribed, and we had almost 1,200 registrations for this afternoon. That itself speaks how important and timely this is, and I thank you, the fortunate 1,000 being the capacity for this webinar, for joining us for this important workshop on the ISSB standards. Thanks heaps really to the UNSSE, the IFRS Foundation, and the World Bank for facilitating this workshop. Now, Malaysia's sustainability reporting landscape has entered a new phase with the National Sustainability Reporting Framework, i.e. the NSRF. Now, in effect, the ISSB standards form the baseline for sustainability disclosure in Malaysia, giving the market a common language for transparency, comparability, and investor decision-making. Now, that shift matters. The central question is no longer simply whether sustainability issues are mentioned, but whether they are identified, assessed, governed, and reported with clarity, consistency, and credibility. In practice, that means sustainability reporting must be embedded across the organization in governance, strategy, risk management, finance, and performance oversight. Now, this workshop has been designed to support that transition. It will give you practical guidance, direct access to experts involved in the standards, and a chance to explore how the requirements apply in real-world settings. Bursa Malaysia's current approach reflects a clear balance, a phased implementation that recognizes readiness alongside a firm direction towards global aligned reporting. The message to preparers and industry is that the journey is underway and the expectations are becoming more defined. As you listen and participate today, I would encourage you to reflect on 3 points. Are your disclosures supported by reliable processes and data? Is sustainability reporting a truly cross-functional responsibility in your organization? And thirdly, are you using this exercise to comply or to improve the quality of decisions, oversight, and long-term resilience? Now, with that, I wish you a productive session and I encourage you to participate actively throughout. Thank you. Back to you, Fiona.
Thanks so much, Julian, and fantastic as ever to hear about the great progress being made in Malaysia on adoption of these standards through your national framework as well. So we'll be aiming to support with that topic in particular today. So big thanks for joining us and for setting the scene for us there as well. Great, fantastic. Well, with that, let's get into a little bit of a practical overview from my side, just of how the session will work today and a few housekeeping points. So firstly, just to note on audio settings, I can see we've had a few people commenting in the chat that they're experiencing echo issues. I'll just look to my panelists to correct me if you're hearing the same, but from my side, there isn't an audio issue. So I believe the most common reason usually that this happens is if you have Zoom open in more than one window at the same time. In particular, perhaps if you have the desktop of Zoom open and a browser window. Please double check you have only one Zoom window open, and you can also try to rejoin us or connect a different audio device, perhaps if your particular device is having issues. But thanks for those who've confirmed you can hear us okay in the chat. On a practical level as well, if you've got particular questions for the team, whether they be questions on the content or practical questions as well, make sure to put those in the Q&A box that you'll see on the screen there. As you can see already, our chat moves very quickly with lots of attendees in the session, so we don't want to lose your question if you put it into the chat. So make sure to use Q&A for any general comments as we move along. Format for the training today, we've got a live 3.5-hour session. We will take a short break in the middle of that. We know that's a long time to be together online. And there is an optional homework assignment which we'll explain to you that will be available for you to use after the session if you'd like to continue your learning. As I've already mentioned, the live option to ask your questions as we move through the session today is available. Just to note, if you have particular questions for the Bursa Malaysia team, they have indicated that it would be most helpful to continue to use the normal route to contact them to share those questions. So any queries relating particularly to sustainability reporting requirements for Bursa Malaysia, it would be great to share those to sustainability@bursamalaysia.com, and I'll just share that email in the chat with you. We'll share that again a few times. However, if you have questions on the standards themselves, on the kind of content requirements, on the best practices or good approaches perhaps to take, you're welcome to continue to share those, and we'll do our best to respond to you in the Q&A. We have a number of IFRS representatives here today who I'll introduce shortly who can support you with that. Throughout the session, there'll be a number of times when your participation is required. We're going to be doing a number of I see more comments on audio, so I'm just checking that, but a number of interactive exercises, I should say. So make sure to take part in those, and we'll explain more about those when we get to them. The other final thing, which I know is very relevant for everyone, is how to get your certificate. So you will be able to get a completion certificate for taking part in today's training. To get your certificate, what you'll need to do is fill out the feedback survey, and we provide you with all the details about that at the end of the session. So keep your kind of eyes tuned for more details about that at the end of the training workshop. Great. So just to introduce who's going to be delivering the training for you today. So I'm Fiona from the UN SSE team. I manage a lot of our training sessions as part of our SSE Academy. Alongside me today, I'm joined by my colleague, Lois Guthrie, who is our senior specialist who'll be supporting us as well. We'll soon be joined in the background as well by our colleague, Tiffany, who's going to be answering some of your questions. Tiffany's head of our SSE Academy. And then alongside us today, unfortunately, our colleague Robert was unwell at the last minute, so he's had to step away from the training, but we're very ably joined today by Bella Cheng from the IFRS Foundation Sustainability team. Bella is a capacity building specialist. Alongside Bella, we've also got her colleagues joining us who'll be supporting with Q&A as well. So thank you to Visvesh and to Rebecca, who'll be joining us a little bit later as well, who'll be supporting in answering your questions. So what are we aiming to achieve in our training workshop today? Well, there's really 3 key things that we're looking to move forward on. So firstly, to help you to understand the ISSB standards. So understand what they are and what the contents of the standards is. And you'll find this aligns very closely to what sits within your national reporting framework as well, on which, of course, was based on these standards. Secondly, we like to help you to understand how you can use and apply the standards. So putting them into practice in your organizations and thinking about how they interconnect with other requirements you may be using. And then finally, we'd like to help you to identify the steps that you can take to develop a disclosure plan. So this is all around putting into practice the standards and thinking about how to do so in a way that's strategic and really maximizes the benefit for your organization as well. So to help us achieve those three objectives, we set out a four-module structure that we're going to be working through in our training today, which you'll see on the screen now. So we're going to start in prepare on the left-hand side, and we'll move around that wheel in a clockwise manner. So firstly, in prepare, as I said, we'll be thinking about building on your existing knowledge that you might have about sustainability reporting. So thinking about the case or purpose for sustainability reporting and how the global baseline of the ISSB standards was developed. Within module two, align, we're then thinking about how we can start to align with these particular standards and how they connect to perhaps existing requirements that you might have already been using, such as voluntary reporting frameworks, and also how you can think about the geographical, sector, or regulatory requirements that you might need to meet alongside the standards. In our implement module, we're then going to be getting into the practices and systems that you're going to need to adopt to help you to identify, evaluate, and integrate sustainability related issues into your disclosures and your wider businesses as well. And then finally, we'll finish with communicate. So this is thinking about the final format of your reporting, what location to put the information in, the timing of your disclosures, and how to do so with efficiency and confidence. Great. And so just to show you how that module structure breaks down across our session today. Sorry, I think the slide's just taking a moment to change, but hopefully it's on its way. There we go. You'll see that we have around 45 minutes on our first module. Our second module, Align, where we really introduce the detailed content requirements, is a larger one, so we'll take a short break in the middle of that. And then we'll spend the final hour of the session on our last two modules before we wrap up and share with you some additional resources and details about that homework assignment. So one important thing to mention, it might perhaps relate to some of the questions I've seen popping up in the chat, is that you do already have access to the training content from today's session if you'd like to look at it. So there's a link that we're going to share with you in the chat, and we'll share it a number of times, and that's to the page where you signed up from for today's session. At the bottom of that page, and thanks Lois who's just shared that message, at the bottom of that page that Lois has just shared, you can download the slide presentation that we're sharing with you now and the homework assignment. And we're also going to add the recording of today's session to that same page after the session as well. So if you go to that handout, you'll be able to find from the slides all of the links to the different resources that we'll share with you today. So you can follow along with that and look at some of the links that we'll share. We'll also share a number of those in the chat throughout, but recommend referring to that slide presentation handout if you'd like to see all of those resources collated in one location. Just a reminder as well for any questions that you might have, as Tiffany just mentioned in the chat there, we're getting lots of chat messages, so make sure you're putting any particular questions for us into the Q&A box. I did see a number of hands were raised. Unfortunately, we can't take live questions, but if you did have your hand up because you had a question for us, be sure to put those into the Q&A box as well. And then finally, in terms of a homework assignment, I've mentioned that a number of times, but we do have an optional assignment that you can take away after your training workshop today. So it isn't mandatory to complete this homework, but it's really designed to help you to continue your learning and put into practice what we're talking about. So you'll be able to find that homework assignment on the same page that we've shared with you in the chat box, the page for today's session at the bottom. And then just to mention as well, another few key resources. So we have the SSE's toolkit of resources, which is available to you. So this is designed to really support adoption of the IFRS standards. So be sure to check out the link to this, which Lois has just shared in the chat. You can also access that from the QR code on the screen. And maybe one important thing to highlight about this resource is that we have an FAQ database there of lots of questions that we've answered and collated responses to from today's training. So recommend checking out those questions for any particular answers as well. Great. So before we get into the session, I do see Lopa from the IFC, you have joined us as well. Sorry, I just skipped past the opening a little bit earlier as I saw you weren't there at the time, but we can flick back to that now if you've got any brief comments you'd like to say in opening. So Lopa is the ESG officer responsible for your region at the IFC, the International Finance Corporation, which is part of the World Bank Group. So her team are doing lots of great things in your region. And so, Lopa, if there's anything you'd like to cover it off now as a quick opening comment on those points, do feel free to come in. I don't see you on camera though, so perhaps that's an indication that we should move along. Okay, let's do so. But if there is anything, Lopa, that you'd like to contribute later in the session, please just let me know. Okay, but moving on in terms of the content side of things, one thing we'd like to do just to kick things off is to get a sense from you all as to why you've joined us here in the session today and what you're looking to get out of it, and maybe how much you already know about these topics. So there's going to be a link shared in the chat with you just now to join us in Mentimeter. So I'll just share my screen now as well to show you another couple of options for how you can join us in Menti. Great. So within Menti, you'll see on the screen here a QR code. So you can scan that QR code on your phone if you'd like to use Menti on your phone. You can also go to menti.com and enter that 8-number code that you can see on the screen now. Or perhaps one of the easiest ways is to click that link that Lois has just shared with you in the chat, and that will take you straight to your first question. So the first question in Menti for you is just to tell us in your own words what your reasons are for joining us in today's training, what you're most interested to learn in our session today. Great. So I see learning, understanding, compliance, maybe a refresher. Perhaps some of you are already working on this topic, but as you say, great to refresh your knowledge and come back to this. So good to see that as well. I see alignment, awareness, capacity building. Maybe you're curious, someone has mentioned, building your understanding, a genuine interest. Great. Okay, fantastic. Thanks, everyone. That is showing us already lots of great reasons for being here and lots of answers coming in on Menti. So do keep that up. It's always great to get lots of your input to the Mentimeters. So let's move on to our second warm-up question, which is just to get a sense of where you're at with your current understanding on the ISSB standards. So you can use that sliding scale you'll see on the screen currently to let us know how comfortable you are with each of these tasks that you'll see on the screen here. So explaining what to team members what the ISSB is, maybe on using the ISSB standards, and also on developing a sustainability reporting strategy. So it looks like for most of you, we're somewhere in the middle to lower end of the scale. We've got quite a range, I think it's fair to say. So lots of you obviously in the process already of getting to grips with and using the standards, which is hopefully a great reason for joining us here today. But yeah, great to see that. So thanks everyone for letting us know that. Great. So we'll go back to the slides now. But Lopa, I do see you're on screen currently. I'm not sure if you're ready to come in, if there's anything you'd like to say briefly just to set things off.
Thanks so much, Fiona and Tiffany, for inviting me. So just wanted to, add that we really value this partnership with UNSSC and both our IFC's global team through the Beyond the Balance Sheet program, as well as through our regional programs. We do have a strong partnership with the IFRS Foundation as well as UNSSC, and together, we launched our ISSB training programs in January 2024. And since then, over 24,000 participants across 41 markets have attended the training program. So huge reach, both locally and globally. And we hope to move the needle through these capacity building programs. And I see that today more than 1,000, you've maxed out on the participants. So really happy to see that Malaysia has also taken a keen interest in joining the UNSSC programs. So for IFC, it's of critical importance because of the investment that we do. And because we have a large footprint of working in emerging markets, and transparency disclosure is one of our key decision-making considerations. So we do really hold this in the highest of importance, and we hope to create greater impact through these partnerships. So we work at the market level in improving the practices, but also we work with individual firms and clients that may need our help, and then they can reach out to us if they need additional support or additional handholding to help with their own individual companies reporting. So just wanted to add that. Thank you.
Fantastic. Thank you, Lopa. And I'm sure companies will be very pleased to know of those additional support avenues available to them. So do encourage people to look at the Beyond the Balance Sheet link, which has just been shared in the chat, and to follow up through the contact details in this presentation if you've got any questions as well that you think the IFC might be able to help with. Great. So let me just take us back into the slide presentation now. So before we get started, I've just got a quick disclaimer that I'm going to share with you, and then we'll jump into the content of today's session. So this disclaimer is just to be clear about how we're going to be using company disclosure examples in today's training. It's really just to add some practical examples, some possible inspiration, but any example that we share shouldn't be seen as an endorsement of best practice or necessarily that we're saying that this is the right way to do this, because we know, of course, that each company's circumstances are unique and you need to report in the way that is most appropriate to your own circumstances. But we hope the examples that we share can serve as a little bit of an inspiration nonetheless. So moving into our first module, prepare. So this is really all around building that solid foundation of knowledge to move forward from on this topic. And in this topic, we like to cover three key things. So firstly, starting with the purpose and case for sustainability reporting, then moving into the landscape and thinking about how this has evolved to reach the baseline of the ISSB standards. And then in the final segment, the global baseline will introduce the standards themselves to you and explain a little bit more detail what sits within them. So to get us started on the purpose aspect, we'll kick off by looking a little bit about the case and the market drivers for reporting. And so to get us started with that, I think it would be great to hear from everyone here what your drivers are. So I'll just launch a poll question for you now. And you can let us know by selecting as many of these options that pop up in the poll as are relevant, which of these is the reasons that you are disclosing or maybe thinking about disclosing sustainability related information. So I'll give you all a moment to respond. I see responses coming in thick and fast on the poll, so thanks for participating that. So let's see. I'll give you all a couple of seconds, but I'm seeing lots of responses already. So I think in the interest of time, let's end the poll there and we'll share the results. Don't worry if you didn't get the chance to respond. We're doing lots of polls, so keep an eye out for those throughout the session. So it looks like 94% of you said regulatory requirements was one of your reasons. So a very strong market driver, of course, and that's no surprise, of course, with the developments in your market on this front. So obviously for many of you, a key reason for being here. But we also see quite a large proportion of you sharing that investor interest in this topic and maybe sharing your own organization's objectives are also key reasons. So great to understand that wider context and lots of good reasons, I think, for reporting this information, as we'll explore shortly. Although regulatory compliance, of course, is paramount, lots of other benefits that we're going to be able to see beyond that from reporting as well. And so I think one of those is really that investor perspective that you've already mentioned, a number of you there. So we really see that investor interest in this topic has continued to grow year on year for a number of years. And one easy way to perhaps measure that is by looking at the number of investors that are signed up to the Principles for Responsible Investment, which is a set of kind of principles set out by the UN on how to act responsibly as an investor and to incorporate sustainability factors into investment decision making. And so you'll see there that we now have well over 5,000 signatories to these principles, representing more than 128 trillion US dollars in assets under management. So really a sure sign that we are seeing a big uptick overall in the number of investors focused on these types of issues. And so why is it that investors are thinking about this? Well, I think what we really want to highlight here is that a key driver behind this demand from investors is the potential financial effects of sustainability issues. And really that growing recognition that this is a highly relevant thing to consider for long-term value creation and strategic resilience. So the data that you're seeing here comes from a recent study of institutional investors conducted by HSBC. And this found that the top driver for investors to incorporate climate change and environmental issues into their investment strategies was really the perceived impact of these factors on long-term performance. And so you can take a closer look at this study by following the link in the handout, but let's look a little bit closer firstly at what we might mean there by financial performance, which I've just mentioned. So one thing it's really important to remember in our workshop today is that we're talking about disclosing financially material sustainability related information. So we're going to discuss a little bit later in the workshop what the word material means, but we want to be clear from the start about the sorts of financial effects that investors are looking to have more information on. So firstly, let's start with effects on a company's financial performance. And so we often see this reflected in the statement of profit or loss, which shows us income or revenue and expenditure. And so sustainability related risks and opportunities may have financial effects, for example, by changing the revenue mix or total revenue of a company. Perhaps if demand for its products and services change, maybe there's a disruption in its production capacity, or other things as well that could affect that, such as issues within the workforce. And we can also see changes in expenditures. For example, if operating costs were to increase, maybe as a result of rising energy prices, or perhaps an organization needs to spend more in R&D investment in order to capitalize on sustainability related opportunities or manage its risks as well. So those are just a few ways that we might start to see effects on financial performance. And then the other important concept here to talk about are effects on a company's financial position. And so the company's financial position is what's reflected on its balance sheet. And so, for example, a company could also see changes to certain assets or liabilities as a result of sustainability risks and opportunities. So we could see changes to portfolio value. We could even see write-offs of certain assets that perhaps are damaged or needed to be repriced to reflect those risks. And another financial effect that should be documented is changes to financing and the cost of capital. So this could include, for example, equity evaluations that may be impacted by climate risks, as well as making use of new financial structures such as green bonds or social bonds. And then before we move into our next unit, there's just a few key final concepts that we want to flag in this opening segment. And these particularly relate to sustainability related risks and opportunities and some of the unique characteristics here that are important to understand. So firstly, just to show you at a global level, of course, in this training, we're talking more particularly about your individual organization's risk. But if we start at the top line level, we can see from the World Economic Forum a summary of some of the key global risks over a 2-year and a 10-year timeframe. And what is important to highlight here, of course, is that these risks are quite different. So really what we see with sustainability is that something that may pose a significant risk 10 years from now might not necessarily be the key thing we're considering today. And so when we're disclosing, it's important that we're preparing both for those risks that are more in the near term, but also those that we might expect to arrive over a long-term time frame. And because we might need to take action or invest today in measures to mitigate those longer term risks, it's important to also say that we could see financial effects much earlier than the full term of the potential risk time horizon itself. So that's an important thing to keep in mind. And then a final thing just to highlight as well is how interconnected sustainability related risks and opportunities are. So this visual comes from the World Economic Forum's report as well, and it shows a number of different risk types and really all those interconnections that exist between them. And so one thing that is important to be clear on here is that although within the ISSB standards, we talk about 2 standards, one for climate and one for other topics, in practice, these issues are, of course, very interconnected. And so disclosing information on one topic also requires us to consider those interconnections as well and do our best to deal with this in a holistic way. Great, so that's just a few key conceptual foundations that we've established there, a little bit about the purpose and drivers for this topic. I'm going to hand you over to Lois now, who'll get us started by explaining the reporting landscape.
Hello, everyone. Yes, I'm Lois, and I'm going to go through the next part of this module with you. We've covered briefly why sustainability disclosure is important, and we're now going to look at how the standards have been developed within the landscape of existing reporting standards. But before we do that, may we ask you, what standards or frameworks are you currently using for sustainability disclosure? So you can select all that apply here. Are you already using IFRS S1 and S2? Or the Global Reporting Initiative standards, or the Integrated Reporting Framework, or the standards of the Sustainability Accounting Standards Board, the recommendations of the Task Force on Climate-Related Financial Disclosure, European or other regional standards, or anything else? And if so, please do tell us in the chat. Give you a few more minutes to think about that. Yes, of course, many of you already using the Bursa Malaysia Sustainability Reporting Guide. Just to let Fiona know, I can't actually see the poll filling up, but if we could end the poll now and have a look at the results, that would be lovely. Oh, thank you. Yes, I can see that now. So we've shared the results, I think, with you. And of course, you can see that the majority of you are using IFRS S1 and 2 in the shape of the standards as adopted by Malaysia. So that's great to hear. Quite a few of you also using the Global Reporting Initiative, some using integrated reporting. So quite a mix here. And thank you for all of those telling us what you're using in the chat as well. Very interesting to ours. I do hope you could see the results. You can see, I think, that most of you are using IFRS S1 and S2, so you should be familiar with a lot of what we're going to tell you. But let's look at the organisation that developed the standards we'll be talking about today. That's the IFRS Foundation, which is a not-for-profit public interest organisation that was established to develop high-quality, understandable, enforceable, and globally accepted accounting and sustainability disclosure standards. At the bottom of the screen, we see that the Foundation hosts two independent standard setting boards. The International Accounting Standards Board, formed in 2001, sets accounting standards that are now in place in over 160 jurisdictions around the world. And the International Sustainability Standards Board, formed in 2021, released its first two standards in 2023, following strong market demand for its establishment. The two standard setting boards are in the same foundation and they work closely together to ensure that financial and sustainability standards complement each other. Governance of the standard setting boards is provided by trustees, and they are in turn accountable to a monitoring board of public authorities. So how did the ISSB standards come to be? Well, you're surely familiar with a lot of the logos that you see on the screen here, and these organizations have all contributed to the development of sustainability disclosure. Many of them focus on the reporting, the information needs of investors, apart perhaps from GRI, which looks more at impacts as well. So from the arrows, you will see that the arrows are pointing towards the IFRS sustainability logo, and that's because this is actually a picture of harmonization and simplification. So if we start with the organizations at the bottom, CDSB, the Integrated Reporting Framework, and SASB, all of their work has been consolidated into that of the ISSB. The TCFD, the Task Force on Climate-Related Financial Disclosures, their work has also been incorporated into the standards now that the TCFD's work is culminated. The ISSB has taken over responsibility for the disclosure-specific materials of the Transition Plan Task Force, and CDP has aligned its climate questionnaire with IFRS S2. And GRI works very closely with the ISSB to ensure maximum alignment between common disclosures. So this is a picture of harmonisation and simplification. Let's have another look at a Zoom poll now. And the question is, to the extent that differences between reporting frameworks still exist, why is this, do you think? And you can answer as many as you think apply. Is it because different organisations have different reporting objectives, or that their work covers different scopes in terms of subject matter or the companies to which they apply? Do they use different definitions and wording? Are any differences to do with their materiality focus, or is there something else? And if so, let us know in the chat. Give you a moment to think about that. Great to see so many of you participating. Thank you. Just for time, let me share the results with you now. Yes, I mean, really, all of these could apply, but I do agree with the majority of you. Most of the differences are to do with the fact that different organisations have different reporting objectives and different materiality focuses. So you're absolutely right. And yes, there are still different standards, but as you saw from the screen I just shared with you, they are more coalescing more and more and trying to work together to simplify the disclosure landscape. So yes, all your answers were correct, and thank you for participating in that Zoom poll. Let's move on now. Well, I mentioned that the TCFD is one of the organisations on whose work the ISSB relied when developing its standards. But if we look at a comparison between IFRS S2 and the TCFD disclosures, this typically explains why there were some differences and how they've been harmonised, which you can look at more in the comparison document that we've linked to there if you wish to. But briefly, the only differences were to do with different wording, but actually wording to capture the same information. S2 requires more detailed information than TCFD did, and an example would be S2 asks for explanations of how carbon credits might be used to cover any greenhouse gas reporting targets, reduction targets. And finally, S2 provides additional requirements and guidance. And a good example there would be the sector-specific requirements associated with the ISSB standards that we'll be talking about a bit more later. Let's look at the objectives now of the ISSB. The objective was to set a global baseline that would form a common language for sustainability-related financial information and enable comparable and consistent sustainability disclosures across global capital markets. And the Foundation is working with jurisdictions around the world to achieve this, of course, Malaysia included. However, what would happen if, in addition to the global baseline represented by the ISSB standards, regulators or stock exchanges wanted to ask companies to disclose further information? Well, they can do that by adding their own additional building blocks of information requirements tailored to their needs. And for example, this could include stock exchange guidance on disclosures. So such additional disclosures or building blocks can be required as long as that information is presented in a way that doesn't obscure the disclosures required by the global baseline. So what could an additional disclosure look like? Well, it could, for example, include the sorts of information that are included in the Global Reporting Initiative standards or jurisdiction-specific information relevant to investors in a particular jurisdiction. So taking this building block approach reduces the need to duplicate information by having a globally consistent baseline of disclosures for capital markets while still allowing you to report additional information based on global standards like the GRIs. Though there's been global backing for this approach that's represented in the ISSB standards, the International Organization of Securities Commissions has endorsed the ISSB standards and asked their 130 members to consider how they could incorporate the ISSB standards into their regulatory frameworks. The Foundation engages with other stakeholders on adoption and related issues. For example, the International Auditing and Assurance Standards Board, who have issued their new assurance standard for sustainability disclosures, which we link there, which is ISSA 5000. As part of its regulatory implementation program, the Foundation is supporting multiple jurisdictions with planning and preparation for voluntary and mandatory adoption, and is working with stakeholders around the world who are considering voluntary application of the standards. So talking of the standards, we're going to hand over to our colleague Bella now, who's going to start talking to us about the standards in more detail. Over to you, Bella.
Thank you so much, Lois. Yes, let's continue with the ISSB standards. Yes, we talked about the business case and the market case for sustainability reporting, the evolution of the landscape and how it is being simplified and rationalized. Now let's introduce IFRS S1 and S2. As we start, it's important to know that there are some key terms that should be understood. You can find the definitions in your handout, but I wanted to briefly mention them here. First of all, we will be saying the phrase sustainability-related financial information quite a lot. This can be information about a broad set of issues, including climate, nature or biodiversity, human, social, or others. And sustainability-related financial information is information about a company's sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. And what are the sustainability-related risks and opportunities? They are those that could reasonably be expected to affect the company's cash flows, access to finance, or cost of capital. It could affect the company's prospects. We will also often refer to general purpose financial reports, which includes a company's financial statements and a management commentary. You might know this as a management report, management review, management discussion analysis, or strategic report. Some regulators require specific disclosures in certain parts of general purpose financial reports, so we use this generic phrase throughout. Here we have just summarized the key points of each term, but you can also refer to S1 for fuller definition of each of these phrases. Okay. So anyone familiar with TCFD will recognize the same 4 core pillars or content areas for the ISSB standards. These are governance, strategy, risk management, and metrics and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of the 4 content areas today, and I encourage you to download the standards as part of your homework assignment. So to all the preparers listening, let me start by saying don't be afraid. Yes, there is a lot to understand, but you might be surprised that some of the detail is familiar. And for all the accountants listening, you too will be relieved to see many of conceptual foundations developed by the ASB in the ISSB standards. So let's start with IFRS 1, the general requirements for disclosure of sustainability-related financial information. S1 sets out general requirements for the content and the presentation of material information about sustainability-related risks and opportunities. And if you are familiar with TCFD, you will see the same architecture applied through all the standards. And for matters other than climate, S1 asks preparers to refer to and consider the applicability of the SASB standards and the other sources of further guidance to identify sustainability-related risks and opportunities, and also identify material information about them. And the SASB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operation. Finally, the standards can be used in conjunction with any accounting requirements. The scope of S1 is all sustainability-related risks and opportunities, and the second standard, S2, focuses on climate disclosures, building on the same foundations of S1. So, for example, S2 fully incorporates the recommendations of TCFD. And S2 sets out the requirements for a company to disclose material information about its climate-related risks and opportunities. And it requires the disclosure of both cross-industry and industry-specific information. In terms of climate-related risks, these include both physical and transition risk, which we will come back to later. Other specific climate-related disclosures are required, for example, on scenario analysis and GHG emissions. And preparers must also refer to and consider the applicability of the industry-based guidance on implementing IFRS S2, such as the SASB standards. These are organized by industry, enabling a company to identify climate-related disclosure topics and metrics applicable to its business model and operations. And it's really important to know that S1 and S2 are not standalone standards. They are a package and must be applied together. Even when a company is reporting only on climate-related risks and opportunities, the company must apply both S1 and S2. This is because S1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for investors. S1 also explains the concept of materiality and how companies identify material sustainability-related financial information. So next, let's consider some of the conceptual foundations that underpin the SSB standards, which might be new to anyone without an accounting background. These concepts help us to understand how best to disclose information in order to meet the requirements of the SSB standards. And to start with, companies must fairly present a complete set of sustainability-related risks and opportunities. And fair presentation also requires disclosures to be faithfully represented. To achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. And in terms of the reporting company, and we use reporting entity concept. This concept requires organizational boundary for sustainability-related financial disclosures and financial statements to be the same. Another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. The SSB standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between disclosures in the four content areas, and connections between sustainability-related financial disclosures and the main financial statements. So let's take a few minutes to see an example. So over to you, Lois.
Thank you, Bella. And because this is our first example today, could I just remind everyone of the disclaimer that Fiona mentioned earlier? We use real life examples in the training today to illustrate certain concepts to you, but they're really to inspire you. These examples are not to be regarded as best practice or good practice or endorsed by the ISSB. We're just trying to illustrate some of these concepts to you, and bear in mind that some of the examples are from previous reporting years. Start with this one though. This is from BHP's annual report 2024, and BHP is a global mining company, and the example is used to illustrate connectivity, how different information is connected. And in particular, in this part of the disclosure shows how BHP manages climate-related risks and plans to transition to a net zero economy. And the extract describes the impact of the company's climate-related risk assessment and climate scenario analysis on the company's business and capital allocation plans. So they're connecting those things. The extract describes the impact of the company's climate-related risk assessment and climate scenario analysis on the business and capital allocation plans. As I said, in the first paragraph, the company tells us that they integrate the climate risk assessment and climate scenario analysis into their strategy, and they're treated as a sensitivity in their capital allocation process. So connections and alignment between the company's capital allocation plans and a rapidly decarbonisation global economy are also considered. In the second paragraph, the company tells us that some of their assessments are still in progress, and in particular, the effect of future physical climate-related risks on the company's operations, productivities, and costs. But the company tells us that those results will be used to inform and therefore connect with the company's overall risk profile, corporate planning, controls, and adaptation measures. The light grey text at the bottom of the extract shows where the connections to further information on the impacts of climate-related risks can be found on operational activities, greenhouse gas emissions across the value chain, financial statements and production, revenue and expenditure. So a small extract, just one example about how the effects of climate change are connected with decisions and plans about standard business processes on operations, risks, controls, and finance. Back to you, Bella.
Thank you, Lois. So I think it's time for a Zoom poll. So let's see whether you've already understand the concept of connection or connected information. So the question is, what information should be considered for connected information? Is it connections between governance, strategy, risk management, and metrics and targets? Or connections between sustainability-related financial disclosures and financial statements? Or connections between sustainability-related risks and opportunities? Okay, so the rate of participation is increasing. And yes, I'm going to end this Zoom poll now and share the results. Okay, so I believe you can see the results, and well done, all of you. I think most of you have selected the correct answer. And just remember that what I introduced earlier about connecting information, and also about the example that Lois introduced. So connections involve the three aspects for the for content areas, for sustainability-related financial disclosures and financial statements, and also sustainability-related risks and opportunities. Okay, so now let's continue with the slides. Yep. The standards are built on the concept of materiality as defined by the IFRS Foundation. We are going to go into this in more detail later, but just to highlight that we will be referring today to material information, which is information that if omitted, misstated, or obscured, could reasonably be expected to affect investor decision-making. During the SSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. In addition to the standards and the application guidance published in 2023, a number of educational resources were also published, and since then others have followed, including the IFRS Knowledge Hub. We are also in the process of gathering examples and case studies provided by our partners. And the SASB standards were used to create the industry-based guidance accompanying S2, and the IFRS credential was also updated with more planned to come. I should also note that the IFRS Foundation's capacity building program, which was launched at COP27, is a key part of our support to preparers, and the SSE training initiative is one of our most important deliverables. Okay, so let's continue with another Zoom poll to test what you have learned so far. Okay, so the question is, water is a vital input to our business, but the SSB standards do not currently have a specific standard on water. What do you do? So is it do not disclose anything about water, or consult the sources of guidance listed by SSB, or engage a consultancy to help, or you may choose copy your competitors' reporting. Okay, so I'm so glad to see that more than half of you have participated in this Zoom poll. Okay, so I'm going to end the Zoom poll now and share the results. Okay. Okay. So well done. 83% of participants have chosen the correct answer. Yes, the only correct answer is B. So even where the SSB hasn't yet issued a topic-specific standard, that doesn't mean companies ignore the issue if it is material. Instead, the standards explicitly allow and expect companies to look to other relevant sources of guidance, such as CDSB water guidance, including industry standards and frameworks to identify and disclose material sustainability-related risks and opportunities. So for this question, the only correct answer is option B. But maybe some of you may think that engage a consultancy to help or copy your competitors' reporting is also helpful. Okay, so I think I'm going to hand over to Fiona for Module 1 summary.
Great, thanks very much for that, Bella. Fantastic. So before we wrap up this module, we'll take a brief moment now just to recap on what we've covered so far. So firstly, we reviewed the purpose of sustainability-related disclosures, and I think really we're hoping one of the key takeaways that you'll get from today's workshop is that there are important benefits, both internally and externally, for collecting and disclosing sustainability-related financial information. So whilst, of course, regulatory compliance is very important, if you're not really aiming to make good use of that data that you're collecting to improve your own strategic decision-making, you're really missing an opportunity here. As well, if you have operations in difficult to abate or high impact sectors, it could well be that your competitors are already disclosing these risks and identifying opportunities that they're pursuing. And that will then leave your investors wondering why you're lagging behind and not identifying and managing the same issues, which ultimately could start to affect your equity evaluation or your ability to access capital as well. And then next we looked at the evolution of disclosure standards and that formation of the ISSB with the aim of simplifying the reporting landscape. And so when you're thinking about other voluntary disclosures, you shouldn't see those as competing with the ISSB standards, but really building on top of them. And maybe to add there as well, I know that most of you today are particularly coming to focus on the ISSB standards in the context of your national adoption of them as well through the Malaysian national framework. So encourage you to look at that jurisdictional profile link, which I've shared a few times in the chat and the Q&A. And that was produced by the IFRS team to summarize how particularly Malaysia has adopted the ISSB standards and how that connects to the framework that you're all using. So that might be a helpful resource to get a better understanding on that context and connection there. And then finally, in this module, we also introduce the standards and the important concepts that are needed to understand them and use them correctly. And so a really key point to reiterate here is that the standards and the guidance that are sitting alongside them are really designed to meet the information needs of investors. So they're heavily focused on those prospects that we talked about at the start of the session relating to effects on financial performance and position. So be sure to keep that audience in mind as well. Great. So to wrap up our first module, we're going to be going back to Mentimeter now for an exercise. So you can already join Menti using the link that I've shared in the chat, and I will share the screen for Menti shortly. I know a few people have asked for the QR code, so you'll see that again in just a moment. But before we go back to Menti, just to set up a little bit of a structure here. So I think this really links in through the exercises to what we'd like you to think about in your organization's disclosure plan. And you can use that homework assignment we've mentioned to you to develop your organization's disclosure plan. So I think a few key things that are really important to get clear on at outset of your disclosure plan are what the objectives are for your sustainability disclosures. So really being clear on what you're trying to achieve through your sustainability reporting and making sure there's a common understanding within your organization of that. And it's also something you can share with your external stakeholders. So for example, here you may want to specify the particular reporting requirements that you're seeking to meet, perhaps the particular stakeholder audiences you're seeking to serve with your disclosures. And you may also want to think about the difference between where you are now and where you need to get to. So for example, if you're just starting out on sustainability reporting, you may need to have quite an ambitious objective here to put in place a lot of different measures to support your reporting. However, maybe if you're already quite well established on disclosure, maybe it's a smaller transition that you need to make to just adopt and align to the standards specifically on top of what you're already doing. But let's have a quick look at that together and just take a moment to reflect really on, in your own organization's context, or perhaps in organizations you're working with, if you're maybe an advisor, what do you think the key objectives are for your organization on this front? So let's see. Thanks for those who've already responded to us here. Lots of answers coming through already. So I'm seeing someone mentioning understanding and alignment, so alignment, I guess. Compliance again with regulatory reporting. I did expect that a few of you might mention that, since I know we had so many of you saying at the start that regulation was a key driver. So of course, it's good to be clear with that objectives and make sure that we start off primarily by ensuring we're compliant. But as we said, we really encourage you to think about some of those other benefits or objectives that you can get out of this as well. And I see a number of you have mentioned those here. So maybe providing transparent and useful information that enables informed investment decisions and supports long-term value creation. Yeah, I think that's a great point there. Coming back to that audience of the investor here and not losing sight of what we're really trying to achieve with the disclosure is information that investors can put into use. We see readers helping your readers to understand your efforts and your future plans. Indeed, definitely. maybe disclosing on material topics and metrics. Someone has also mentioned maybe getting rated by an agency such as FTSE. So yeah, that's another way in which disclosure can be utilized. Your public disclosures are utilized by ratings agencies to inform assessments of your company's ESG performance. So providing that quality, comparable, consistent information is likely to contribute to better performance in those ratings. We're seeing a mention of providing credible and comparable information as well. Someone also has mentioned maybe they're supporting clients as well on this topic. So exactly. So keeping that in mind if you're advising clients on this topic, that this is really what it's all about, is credible and compliant disclosures that are building stakeholder confidence. Lovely. And I think several people here demonstrating a good balance between that focus on compliance, but keeping that view on long-term value creation and really managing those risks and opportunities as well, I think is an important other point to highlight here. The process of really going through and identifying and disclosing those risks and opportunities is an important opportunity to better understand and build your organization's resilience at the same time. Great. I see several more mentions of compliance and meeting requirements. Let's have a look and see if we see any other perspectives here. Yep, so to align investor requirements with the company's way of managing the business. So that's an interesting perspective there. I'm not sure if you already think there's a good alignment between those things, or maybe you think there's a bit of work to do, but I think this also hopefully offers an opportunity to create a bit of a dialogue with your investors to think about that point, and make sure that they really understand the way that you're managing these issues in your organization. Driving continuous improvement was mentioned there as well. I think that annual process of preparing a disclosure can be a helpful way of making sure you're keeping track of your progress, you're continually reviewing how you're meeting your long-term strategic goals, and you're making adjustments as well. Great. Lots of really good responses here. I think we could keep going for quite some time based on how many I see here. So I think it should be possible in Menti for you to continue to have a look at these. So I'll leave this question available to you. But it seems like a lot of you there are already well clear and have clarified well your objectives here. And particularly, I think those responses where you're balancing that focus on compliance with that long-term future planning for your own organization, I think are thinking about this in a really good way. Great, so let me take us back to the slide presentation now, and I'll pass us to Bella, who's going to get us started on our second module.
Thank you so much, Fiona, sorry. Yes, yes, let's continue with the slides. Okay. So now we have introduced the initial concepts. Let's dive into how to apply the SSB standards, taking into account additional disclosures, including any relevant geographical or sectorial requirements, as well as peer practices and your leadership's objectives. In order to understand how to ensure your disclosures meet global standards, we will look at two key concepts in this unit. And the first and the main focus of this unit will be on how to apply the standards as part of the global baseline for sustainability-related financial disclosures for capital markets. Once we cover that, we will also discuss how additional disclosures be. Okay, so to begin, let's focus first on how to apply the SSB standards as the global baseline. Let's get started on the first core content area, governance. This aspect is centered on understanding how oversight for sustainability-related issues is providing in the organization through the processes, controls, and procedures that have been put in place at board and management level. For each of the core content areas, we'll discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements, for example, as part of a gap analysis. So if we look at the governance and the management requirements, we can see that there are several that are fairly qualitative. For example, which bodies are responsible for the oversight and the management of processes, controls, and procedures of sustainability-related risks and opportunities. Is management responsibility delegated to a specific role or committee? You can also ask how and when do they get informed about sustainability-related risks and opportunities? How these issues inform strategy, decision-making, and risk management. This could include setting targets to manage sustainability-related risks and opportunities, and whether progress against these targets links to executive remuneration. For more information, you can make use of the SSE checklist tool, but remember it's not a replacement for reading and using the full SSB standards. So let's take a look at an example to see what we mean in practice. So over to you, Lois.
Yes, thank you, Bella. And first we have an example from Yara's integrated report, and Yara is a large global crop nutrition company. And in this governance model example from their sustainability statements, we see that Yara has a highly integrated model, meaning that responsibilities for sustainability are embedded across a number of business functions, including risk management, health, safety, environment and quality, HR, and global climate and energy. And you can see all those departments there in the yellow boxes in the middle of the screen. So let's look at this in a bit more detail. The board of directors and the president and CEO are shown in the dark brown boxes at the top and the middle of the screen. The board audit and sustainability committee on the far left, they assist the board of directors in overseeing the process for and internal control of sustainability reporting and material impacts, risks and opportunities. So we have the board of directors assisted by the board audit and sustainability committee. In addition, we have in the yellow boxes the sustainability governance team. Now they have a direct reporting line to the chief financial officer, and that governance team are responsible for sustainability performance and reporting, and their work is closely aligned with corporate performance and risk management functions. Right at the bottom of the screen, we've also got the Sustainability Network, and they review Yara's accountability processes and systems in place for ESG policies, and they monitor sustainability performance. And that network is chaired by the Chief Compliance Officer. So you can see the reporting lines, you can see all the different committees and networks that assist the board in their job. And the arrows indicate how the flow of information and input works between these different governance bodies. Now, this is just one example, and there are multiple governance models that you can choose from. The ISSB standards do not require a particular governance model. Your organization should use a governance structure that's fit for purpose, that fits the particular needs of your companies and its legal environment. Let's have a look at one more example about governance now, and this is from Petronas, which is Malaysia's national oil and gas company and a global energy group with a large presence around the world. In this example, the governance structure shows the executive, non-executive and independent roles of the board of directors and the three committees to which the board delegates authority, responsibility and operations. Now, climate-related matters are included in the responsibility of all three board committees. The audit committee monitors climate-related reporting. And later in the report, not in this extract, you can see that it provides assurance on the state of governance controls and compliance in relation to greenhouse gas emissions reporting. The Nomination and Remuneration Committee reviews the President and Group CEO's performance scorecard, which includes climate-related measures, and the Risk Committee's work includes climate-related risks and mitigations. And at the bottom of the image, you can see that the executive leadership teams also include, their duties also include sustainability, and they report to and assist the board. So we've got another integrated structure here where responsibility for climate and sustainability matters are embedded across multiple functions, not just one. And using this structure aims to provide clarity and accountability, strategic alignment across the group, and aims to facilitate decision making at all levels. So we've covered governance, the first core content area now, and Fiona's going to take us through the strategy content area.
Thank you, Lois. Great. So as we said, hopefully those examples have helped to make governance quite clear. So moving now into the next core content area of strategy, there are more disclosure requirements included in this area, but it is also really where we think that companies can see the benefits from sustainability-related opportunities and being better prepared for risks as well. And so this content area focuses on understanding what the company's strategy is for managing its sustainability-related risks and opportunities. And there are three high-level areas that we'll focus on in the strategy content area. And these are the risks and opportunities, their effects, and then resilience. So we'll take a little bit of a moment to review each of these areas. So if we start with risks and opportunities, there's a number of questions to evaluate here and think about this topic. So IFRS S1 and S2 disclosure requirements on strategy are really designed to enable users of general purpose financial reports to understand how that company is managing its sustainability related risks and opportunities. And so when disclosing information about this, you'll want to start to think about what those risks and opportunities are that you would expect could affect your company, to describe what the effects are, and then the time horizons over which the effects could be expected. Keeping in mind here that those financial effects could occur before the risk or opportunity materializes and or afterwards, and could also change over time as well. And then the last two questions on this list look particularly at climate change. And so these align with the requirements from S2. So for example, investors also want to understand what types of risk or opportunity are being considered here. And S2 requires companies to identify climate-related risks using the categories that we drew from the TCFD of physical and transition risks. And both S1 and S2 include guidance to support companies as they identify and disclose material information about risks and opportunities. For example, by using industry-based guidance and also the SASB standards. And so we know this can often be easier to understand with an example as well. So let's take a look at one now. And so our first example here comes from Mondi Group's integrated report. So Mondi Group is an international packaging and paper company operating across Europe, North America, and Africa. And so this extract just shows us the summary of the different risks that they've identified and disclosed in their reporting. So starting on the left-hand side, we see the disclosure of their overall principal risks, which you're probably familiar with as a content area in many companies' reports. But we see here that they've disclosed how these particular risks align with 4 areas. So the categories of strategy, finance, operational, and compliance. They also identify the delegated risk owner for each risk, and they link them to the aspects of their strategy as well. And then as they've identified climate change within their risks there as a key risk area, on the right-hand side, they then analyse in more detail the particular climate-related risks and opportunities that they expect to face, including those categories of physical and transition risks that they talked about this. And so as well as identifying those risks through an evaluation process that they've described in the report, Mondi then show in the disclosure the estimated financial impact ranges, the time horizons, including differentiating between the onset and the full impact of the risk or opportunity, and also the sensitivity of these risks and opportunities in terms of their likelihood, under different temperature scenarios. So a few extra concepts that we're going to come onto in more detail. But the main thing, just to summarize here, is that they've given an example of how they have sort of disclosed the different risks that they've identified in a concise manner. So moving on then to another aspect of the risks and opportunities identified as potentially affecting the company's prospects that would need to be disclosed is bringing us back really to something that we talked about at the start of the session relating to time horizons. And you might remember that we talked about this. We did say that time can be a little bit of a different consideration when we're talking about sustainability related disclosures. So within the standards, you're asked to identify within what time horizons the effects of each sustainability related risk or opportunity could reasonably be expected to occur. And how you define short, medium, and long-term time horizons will vary between companies because it depends on a number of contextual factors. For example, your investment and business planning cycles, your strategic planning horizons, perhaps the lifespan of your assets, or the assessment periods used by your investors. But what's important to keep in mind here is that time horizons do need to be defined. So don't expect that your investors will necessarily know what you mean by short term or medium term unless you give them, just seeing a bit of movement on the slides here. So I'll just ask my colleagues who have slide control. Oh dear. Okay. Give me 1 second. Sorry, I'll just remove slide control for now. Sorry about that, everyone. And we'll go back to the slide we were on. So we were just finishing up there. It's important to make sure you've defined those time horizons for your investors. If we move on now to the next group of disclosures in the strategy category, so the first section there related to identifying the risks and opportunities, and this next area is getting into thinking about what the effects of those risks and opportunities will be and where we might expect to see those effects occurring within the business. So to start tackling these disclosure requirements, companies will really want to ask themselves questions such as beginning to describe the effects and understanding the responses they have planned to mitigate or adapt to them. So you can see here some of the questions that companies will want to use to get themselves thinking about these issues. Overall, what is their capacity to respond? Where do they think these effects could occur? And building out their understanding of that and how they might want to analyze it in more detail as well. So we'll look here again at another example. This comes from BASF's annual report, which is a global chemicals company. And here we'd just like to highlight in particular how BASF have explained and summarized the effects of sustainability related risks and opportunities on its business model and its value chain. So this diagram is just a small summary of what the wider report covers, which I'll talk about a little bit for you now. But as always, encourage you to click on the links to see the reports if you'd like to read the disclosure in more detail. So the visual just illustrates some of the projects that form part of the company's sustainability strategy. The strategy they refer to as winning ways, and it really focuses on how the company can supply products that contribute to sustainability through the use of the products or perhaps through reducing their carbon footprint. And what we see is that they've got a number of projects operating across the value chain, which respond to the different issues that they've identified at those value chain phases. So, for example, in the upstream, they're really focused on the procurement of more sustainable materials, the sourcing of renewable energy, and the management of their supplier relationships as well. Within their own operations, they're thinking about how to improve the efficiency of their chemical production processes and reduce their emissions. And then finally, in the downstream area, they're really thinking about aligning with their customer needs, responding to changing customer demands, and also focusing on the opportunities they have where customers might be willing to pay more for more sustainable solutions, for example. So this just really helps to see how those sustainability risks and opportunities they may have identified for themselves translate into the different elements of their business model and value chain that they are changing to respond to that demand. And so when we're talking about effects of sustainability-related risks or opportunities, one thing that we know can be quite difficult for companies is to understand the types of detail to disclose relating to quantitative and qualitative information. So in many disclosures at the moment, we do see predominantly qualitative information, but we are also seeing a growing numbers of companies being able to quantify disclosures. And so we should also be clear as well on what the standards say about this. So a company is required to disclose both quantitative and qualitative information about the financial effects of sustainability risks and opportunities. But there are a number of criteria in the standard set out for when only qualitative information is required. So, for example, qualitative information can be used if the company cannot separate the effects of a sustainability-related risk or opportunity from another effect. So, for example, if there are various risks contributing to that financial effect, and it isn't possible to isolate the sustainability-specific component contributing to that financial effect. Also, if there's a high level of measurement uncertainty, which would make quantification too difficult. And finally, if the company doesn't have the skills, capabilities, or resources to yet provide that quantitative definition. Great. So moving on then to the final content area of strategy, we've talked about identifying and disclosing the risks and opportunities. We've talked about explaining the effects of the risks and opportunities. And the last part here is concerned with resilience. And so this is thinking really about how the company is prepared for uncertainties and how it's assessed and considered its resilience over the future time horizons. And so this really gets into the practices of scenario analysis. And so for climate-related developments and uncertainties, the S2 standard specifically requires the use of climate-related scenario analysis, using an approach that is commensurate with the company's circumstances. And the disclosure requirements here relate to disclosing what assessment has been undertaken of climate resilience and what the inputs and key assumptions are that have been used in that analysis. So some of the key questions to get started with on this topic is really just thinking about what the company's capacity to react or adjust to any uncertainties is, and how could scenarios be used or how are they already being used to assess that. So turning again to another example here, we're looking at the report of Stora Enso. And Stora is a Finnish and Swedish forest products company. And so they show us in these diagrams what they expect their sales revenues to look like into the future and how they're really incorporating sustainability factors into their business model. So in the top diagram here, we see a summary of how they've kind of identified the sustainability drivers that will contribute to their long-term growth strategy. So they've identified that perhaps they might see a decline in revenues from their traditional business of forests, pulp and wood products, but how they expect to hopefully offset that with new opportunities relating to sustainable building solutions, renewable packaging and biomaterials as well. Then at the bottom of the screen, we're going to see a projection here for how they expect the makeup of their sales revenue to shift from those traditional businesses to the more strategic growth areas. And in the disclosure alongside this, they explain some of the measures they're implementing to really take the strategic decisions now that they need to capitalize on those opportunities. So an example there of how they're thinking about this over a longer term horizon. Great. So we've got a second example here, which comes from Marks and Spencer in the UK. I won't go through this example in detail in the interests of time, but it's just to say that here they have summarized the strategic evaluation of their particular risks and opportunities. They provide a good disclosure on the connection of these issues to financial impacts. They talk about the business responses to these issues, and they also make a connection to their long-term performance and strategic planning. So worth taking a look at this example in the handout if you'd like to see it in more detail. To wrap up this section, I have a poll question for you now, which I'll launch, which comes back to a concept I talked about a few slides ago, which we'll just test if you can remember. So this question is asking about when a company can disclose qualitative information, or perhaps the combination of qualitative information about financial effects. So you might remember I talked about a number of criteria for when just qualitative information or a mix of qualitative and quantitative information is allowed. So let's see if you can remember what were the correct options here. So you can select more than one answer if you think there's more than one correct option. Okay. Give you a few more seconds for the poll. I know someone mentioned that we moved through them quite quickly. My apologies for that, but in the interests of time, we do like to keep the session moving. So no worries if you don't respond, but obviously just good to put your quick response in if you can do, and we'll take a moment to review the answers together. Okay, I see lots of you responding quickly, so thanks for those who've responded already. But we'll end the poll there in the interests of time, and I'll share the results with you. So it looks like most of you thought the top option was correct, which is indeed right. And indeed, for those of you who opted for the second option as well, that's a second case when this is acceptable. So both of these criteria are indeed permitted reasons to disclose qualitative information. However, as most of you correctly guessed, option C is incorrect because, of course, it is important that our disclosures are balanced. So if we do have quantitative information about potentially important negative financial effects, it is important that we are providing transparency to our investors on this. And indeed, if you look at the disclosure examples we've talked through today, you'll see that they do provide that balance of talking about both negative financial impacts and positive ones as well. So important to make sure that balance is there. Great, thanks everyone. So that moves us on now to our next section on some of the climate specific aspects of this area, which Lois is going to talk us through.
Yes, thanks, Fiona. So when disclosing information related to strategy, there are special additional requirements in S2 regarding climate. If you look at the governance requirements, they're very similar across S1 and S2, but when we look at strategy, there are particular requirements about climate. So if Fiona wouldn't mind giving me back the slide control, I shall take you through the climate specific parts of strategy. Yes, here we go. Thank you very much.
Sorry, Lois, I was trying to help you there and we're
That's
changing it at the
okay.
same time. I'll stop touching things.
No problem at all. So here we are at the climate specific strategy points. The first thing is that S2 requires a company to consider the applicability of industry-based disclosure topics and metrics. And you can find guidance on that in the IFRS S2 industry-based guidance. So you'd go to the guidance, you'd select your particular industry, and you'd be able to see what topics and metrics that guidance referred you to. So if you were developing personal products, you might be asked where you were sourcing palm oil from. If you're in the construction industry, you might be asked how you were disposing of particular types of construction waste. If you're in real estate, you'll be asked specific questions about land use and so on. S2 also requires information about where in the business model and value chain climate risks and opportunities are concentrated. So if there's a particular site where physical risks are greater than others, for example, you're asked to provide detailed information on the effects of climate-related risks and opportunities, including how the company has responded to or plans to respond to the identified risks and opportunities. And one of your responses might be to develop a transition plan, and we'll look at that in a moment. In providing disclosures about the current and anticipated effects of the risks and opportunities on the company's financial position, performance and cash flows, S2 sets out criteria for when quantitative and qualitative information is required. So disclosure of qualitative information only is permitted in some circumstances, for example, where a company can't separately identify the effect of the risk or opportunity or when the level of measurement uncertainty involved is too high. In preparing disclosures about the anticipated effects of climate change, S2 requires a company to use all reasonable and supportable information available at the reporting date without undue cost and effort, using an approach commensurate with the company's circumstances. So this recognizes that provision of information about anticipated financial effects can be very challenging. Then on the penultimate point there, in using climate scenario analysis for resilience assessment, that is what a company is required to do, but bear in mind that S2 does not prescribe the specific scenario or scenarios that a company is to use. That's for the company to determine. Having assessed its resilience using scenario analysis, S2 requires that a company should set out significant areas of uncertainty it's considered, whether and to what extent the company has the capacity to adjust and adapt its strategy and business model over time to remain resilient or enhance resilience, and also requires details about when, how, and which scenario analysis was carried out. So I mentioned that one of the responses to climate-related risks and opportunities might be for a company to set a transition plan. And if you do, information is required about that plan. So what does it mean? Well, a transition plan is defined as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy, including, for example, greenhouse gas emissions reductions plans. So if you if you do develop a transition plan, what should its characteristics be? Well, first of all, because it is an aspect of the company's overall strategy, it should align with that strategy and the business case for the strategy, motivation for the transition, and the levers that the company's strategy is most suited for using for decarbonisation. The transition plan could also be aligned with science, including what science says about requirements for net zero to be achieved and how carbon neutrality or Paris-aligned goals are explained in terms of science. The transition plan should set long-term transition goals supported by activities and targets to achieve those goals, including interim targets to monitor progress towards the long-term goal. The transition is uncertain, and therefore the plan should be transparent about those uncertainties, including the dependencies for the plan's progress and success, the risks and challenges of implementing the plan, and how residual or unabated greenhouse gas emissions will be treated. The transition is uncertain, but also for different sectors, and therefore sector-specific pathways could inform the development of the company's transition plan, and we'll look at some resources that can help with that in a moment. And finally, the transition plan will be evaluated by its readers and perhaps investors, and therefore it should have the hallmarks of credibility that the readers would expect. And again, I'm going to look at resources for this now. Now, the little triangle on the left-hand side just shows that organisations developing resources to help with transition plans are designed to support and align with the ISSB requirements. So, for example, the Glasgow Financial Alliance for Net Zero, which sets out guidance, and the Transition Plan Task Force, that pyramid shows that their work supports the ISSB. Perhaps the most useful thing for you to look at is that first piece of guidance there, the IFRS Foundation's own guidance on disclosing information about an entity's climate-related transition, including information about transition plans in accordance with S2. The SSE has also developed some guidance, the UN Sustainable Stock Exchange Model guidance, and in there you can find more practical guidance about transition plans, but also in the appendix we set out the list of hallmarks of a credible transition plan. We talked about the transition developing in different ways for different sectors, and the Glasgow Financial Alliance for Net Zero is one of the organisations that sets out sectoral pathways for different industries, and that might help you. As we said at the beginning, the ISSB now has responsibility for the disclosure materials of the Transition Plan Task Force, and their framework sets out some very useful guidance for developing transition plans. So these are only a few of the resources. Honestly, there are loads of resources, and we list many of them in the UNSSE model guidance if you'd like to know more about transition plans. But you'll be glad to hear that we're now taking a short break. So 5-minute break, have a stretch, think about any more questions you'd like to ask us, get a drink, and we'll look forward to seeing you back here in 5 minutes. everyone, welcome back. I hope you had a good break, a chance for a stretch and a drink, and ready for the next part of our session, which is about risk management. This is the third core content area of the ISSB standards, and this focuses on enabling investors to understand a company's processes to identify, assess, prioritize and monitor sustainability related risks and opportunities, and how those processes, etc., are incorporated into the company's overall risk management process. So what sort of questions might you start to ask yourself when you're contemplating giving disclosures in relation to these requirements? You'll be asking internally, what processes and policies are being used to identify, assess, prioritize and monitor sustainability risks and opportunities, and whether and to what extent they're integrated into the company's overall risk management process. So you might also start thinking and raising questions internally about what inputs and parameters are used for risk management and how suitable they are for sustainability related risks and opportunities. Whether and how those risks and opportunities are prioritized, what criteria are used for assessment, such as nature, likelihood, and magnitude of risks and opportunities. What's the monitoring process, and how do processes change between different reporting periods? And are the sustainability processes, etc., incorporated into the company's overall enterprise risk management process? Let's have a look at how BMW makes disclosures about its risk process. So as you know, BMW is a car manufacturer. This is from their 2024 report, and they're describing here the process for risk management both in words and a diagram. And something to note about this company is it reports risks and opportunities for the current and subsequent financial year. So let's turn to the process that we see in the diagram. Around the edge of the circle, we can see the word appropriateness, and this refers to the risk culture embedded in BMW's core values. We also see effectiveness, referring to the effective management of risks and opportunities. And in the little narrative box, they say there that effective management of risks and opportunities is the foundation of their business success. Down the left-hand side of the blue circle, we can see the group compliance and internal control system form key interfaces to the company's risk management system. So the process is not the responsibility of the risk department alone, and risk management is steered by a centralized risk management function, but it's organized globally as decentralized network with different network representatives and interfaces with internal controls and compliance management. So what does the process itself involve? This is in the pale blue spokes within the wheel. It involves early identification of risks and opportunities, their analysis and evaluation, the use of appropriate risk management tools, including measures, monitoring and assessment of the measures taken, and risk reporting. So having used that process, all material risks are reviewed by the Risk Management Steering Committee, and that's chaired by Group Controlling. And any material risks are then reported to both the Board of Management and the Supervisory Board's Audit Committee. So quite an integrated process again there, where we can see many different departments involved and lots of different processes involved. Let's look for a moment at risk management in the context of the climate requirements in S2. So when disclosing using S2 for risk management, there are some specific points to bear in mind. For example, you'll have to provide details on the inputs that are used to identify and assess risks, the scenario analysis used, and any changes made to the risk management process. And similar requirements apply to opportunities. So just something to bear in mind there more things to take account of in relation to processes for climate-related risks. Also in S2, we actually have a definition of climate-related risks. There are two types. Transition risks arise from efforts to transition to a lower carbon economy, and they in turn are often categorized as policy, legal, technological, market, and reputational risks. And you can see some examples of those in the middle of the screen, perhaps increased pricing of greenhouse gas emissions, more reporting obligations, exposure to litigation, costs of lower emission technologies, changes in consumer behavior, and so on. Secondly, we have physical risks, and these include risks from climate change that can be event-driven. These are acute physical risks that arise from weather-related events such as storms, floods, droughts, or heat waves, which are increasing in severity and frequency, or chronic physical risks that arise from longer-term shifts in climate patterns, so changes in rainfall and temperature, perhaps leading to sea level rise, reduced water availability and quality, biodiversity loss, and changes in soil productivity. Now, in all cases, these risks can give rise to financial effects, affecting a company's cash flows, access to finance, and cost of capital, and over different time horizons, the short, medium, and long term. Similarly, S2 gives us a definition of climate-related opportunities which refer to the potential positive effects for a company arising from the transition to lower carbon economy. These might include efforts to mitigate and adapt to climate change that can create opportunities through innovation in your operations, improving processes, becoming more resource efficient, changing to lower emission sources of energy, taking advantage of supportive policy incentives, and so on. And again, these can have financial effects over different time horizons, just as we saw with risks. Let's have a look at an example now. And this is an example from RS Group, which is a UK-based distributor of electrical and industrial equipment, and they have global operations. So the RS Group have analysed their climate-related risks and opportunities for a number of years, and in the annual report from which this is an extract, the company has identified 10 principal risks, one of which is climate-related transition and physical risks to their business. And this extract is about some of the physical risks. So the most significant physical risks to this organisation relate to the impact of extreme heat on their distribution centres, and we see that on line 1 of the table, and the potential for extreme weather events to cause physical damage and disruption to their customer supply operations, and that's on the second line of the table. On each line, we can see a little red wheel icon, and this shows how strategically the risk mainly affects operational excellence. We've also got other icons to show how and which stakeholder groups are most affected by the risk. As we move through the columns on the table, you can see a description of the risk, the business owner of the risk, so who is responsible, the metrics used to monitor and manage the risk, and in the final column, we see the actions that the company is taking to mitigate the risk, and this includes things like building upgrades, capital investments, and business continuity planning. So quite a detailed description of physical risk there. We're going to hand back to Bella now to take us through the final core content element.
Thank you so much, Lois. Before I continue, so Fiona, are you going to give me the slide control, or you would like to control the slides? Okay, thank you.
I've just given you that, Bella. Thanks.
Yeah. So let's continue with the please. So let's continue with the core content areas. We now spend some time reviewing the disclosure requirements on metrics and targets in more detail, the final core content area of the standards. Here, disclosures are intended to enable investors to understand how the company is performing with respect to its sustainability-related risks and opportunities. Okay, so let's start with metrics. Requirements on metrics are designed to enable investors to understand the company's performance in relation to its sustainability-related risks and opportunities. And preparers shall disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as the methodology. So what is the method of calculation? What were the inputs? Are there limitations? And what assumptions are involved? So now let's move to the second part of this category, targets. Requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals, as well as any targets is required to meet for regulatory purposes. So disclosures include whether they are qualitative or quantitative, and whether it is set voluntarily or by law or regulation. And disclosures also include the metric used to set the target and to monitor progress towards its achievement, the baseline period from which progress is measured, and the period to which the target applies. And disclosures also include what are the milestones and the interim targets, if there have been any revisions to the target, together with an explanation about the revisions. So it's time for an example for CLP to what has CLP disclosed regarding metrics and targets. Over to you, Lois.
Thanks, Bella. Yes, CLP is one of the largest investor-owned power businesses in Asia Pacific, and it aims to be a leading responsible power provider. And this example is about the metrics they use to track waste management and material use. And you'll have noticed that many of the examples we've shown you up to now in this training are to do with climate change, but here we have an example on waste management. And it's important to remember that S1 requires companies to disclose material information about all sustainability related risks and opportunities, including, if appropriate, in material waste management. So this extract from the 2024 Sustainability Report shows waste management and material use metrics for 2024, including the percentage of pollution the company reduces through recycling and removal activities. And bear in mind, this is very much connected to their circular economy strategy and principles and the targets they've set for medium and long-term waste management up to the year 2030. Now, you can see how the company tracks progress in the table. The thing I wanted to point out to you is that, of course, the ISSB doesn't have a waste management standard or educational material or practice statement at the moment. So you'll see in this first little panel that the companies say they've calculated the metrics in line with the SASB and GRI frameworks, and that's absolutely fine, as we'll come on to see a bit later. Their 2024 progress is compared to the 2021 baseline year, in which they set targets for 2025. So we've got metrics and target management here, and we see how they have calculated those things. So I think we're going back to Bella now for more on metrics and targets.
Thank you, Lois. Okay, yeah, you're right. So now let's talk about some of the climate-specific considerations for disclosures on metrics and targets. In relation to metrics, IFRS 2 requires a number of specific disclosures including disclosure of industry-based metrics relevant to a company's business model and activities. And also additional disclosures are required on GHG emissions, including separate disclosures for the consolidated accounting group and associated joint ventures, and the information about the company's financed emissions. In addition, S2 sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 GHG emissions disclosures. While S2 doesn't explicitly require a company to disaggregate its GHG emissions disclosures by the constituent gases, S1 includes requirements on disaggregation that would result in the disclosure of the constituent gases being required if such disaggregation provides material information. I'd like to remind everyone that you can access more information on climate metrics in the SSE's training tool on this topic. We will share the link in the chat, and you can also find it on the SSE's website. Yes, as for metrics, there are some climate-specific disclosure requirements in S2 for targets as well. For example, S2 requires disclosures about how the latest international agreement on climate change has informed the target and whether the target has been validated by a third party. S2 also requires disclosure of more detailed information on GHG emissions targets, including additional information about any planned use of carbon credits to achieve a company's net GHG emissions targets. And S2 also includes additional requirements to disclose information about the approach to setting and reviewing each target, and how it monitors progress against each target, including whether the target was derived using the sectorial decarbonization approach. So questions on GHG emissions often come up in questions on metrics and targets disclosures. So we wanted to address some of these briefly. For those who might not be familiar with different scopes, I would like to briefly introduce here. So for Scope 1 includes all direct emissions that occur from sources owned or controlled by the company, such as emissions from your company's facilities or vehicles. And for Scope 2, it includes emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as the electricity you purchase. And for Scope 3 is all other indirect emissions that occur in the company's value chain. And S2 requires a company to disclose its absolute gross Scope 1, Scope 2, and Scope 3 GHG emissions in accordance with the GHG Protocol corporate standard, unless a jurisdiction requires a company to use a different approach to measurement. If a company is using a different measurement method, there is a transition relief to use that method in its first year of applying the standard. Whether and how the company is using an internal price on carbon for decision making is also one of the requirements of S2. And S2 also requires company to disclose whether and how executive remuneration is linked to climate-related considerations. On 29th of May of 2025, the IFRS Foundation has published educational material which was presented in a Q&A format, detailing the greenhouse gas emissions disclosure requirements under IFRS S2, including measurement, use of the GHG protocol, and how to report scopes 1, 2, and 3 emissions in line with the standard. Okay, so let's see what we mean in practice. So over to you, Lois, for examples.
Thank you, Bella. Yes, and this example is from a company called Vale. Vale is a metals and mining company, and it's from their 2024 integrated report. And it shows their greenhouse gas emissions inventory. The tables on the left show greenhouse gas emissions broken down by scopes 1, 2, and 3, as well as comparative figures going back to 2022 and to the baseline year from which greenhouse gas emissions reduction targets were set. The circular diagram on the right of the screen shows greenhouse gas emissions broken down by their source. So the diagram shows us that mobile combustion activities gave rise to the most greenhouse gas emissions by source, followed by industrial processes. So readers are interested in the breakdown of emissions by scope, but also might want to know where the emissions came from in terms of the activities that the company conducts. There are lots of notes and symbols in this extract. It might be a bit small for you to read, sorry about that, but they're telling us how the results have been prepared. So the inventory has been prepared using the GRI's greenhouse gas emissions statement, GRI 305. And notes tell us that the inventory has been assured by a third party and that the emissions have been reported on a gross basis. That is, before any type of compensation or mitigation. And that's what the ISSB S2 requires. At the bottom of the page, they give an overview of the company's long-term commitments on climate change and a report on their progress from 27 when the baseline for their targets was set. So lots of different ways of breaking down and explaining greenhouse gas emissions there. So let's have another Zoom poll now. And the question is, what is the objective of metrics? And in particular, what is the objective of the ISSB's disclosure requirements on metrics? And you can answer all that apply. Is it to understand the company's performance in relation to sustainability-related risks and opportunities, the progress towards any targets? We've just seen that in the example, or to understand the company's assumptions about the future. Just give you a minute more to think about that. Right, let's share the results now. So those of you that answered A and B are correct, and I'll explain why. The reason we ask the question in this way really is to encourage you to read the standards. They're quite easy to read, they're quite short, but at the beginning of each of the core content areas, the standard sets out why, the objective of asking you for each of these core content areas. And in the case of metrics, S1 paragraph 45 says that the objective of sustainability related financial disclosures on metrics and targets is to enable users of general purpose financial reports to understand the entity's performance in relation to sustainability related risks and opportunities. So that's A. And to understand progress towards any targets the company has set. So that's why A and B are correct, because that's the objective set out in the standards. Of course, giving this information might help readers to understand the company's assumptions for the future, and that's good, but it's not actually exactly in line with the objectives. So let's move on now to the Align module. This is about how you integrate other disclosure requirements that you might be required to comply with that are in addition to what S1 and S2 require. So the building blocks we talked about earlier. So we did talk about this earlier, didn't we? And we said that jurisdictions or others might want to ask for information in addition to the baseline set out in the standards, maybe because there are local listing requirements or because these other requirements align with policy objectives, or because you want to align with emerging industry practices or satisfy the needs of a wider group of stakeholders, all of which is fine. So as we know, the ISSB is working with jurisdictions around the world about adopting the standards and also thinking about what building blocks the jurisdictions might want to apply. Currently, there are over 40 jurisdictions that have adopted, used, or are taking steps to introduce the ISSB standards into their legal or regulatory frameworks. There are jurisdictional profiles, and I know that Fiona shared in the chat a link to the jurisdictional profile for Malaysia that might be interesting to you. And there are other links here that explain the roadmap for adoption of the ISSB standards. Of course, as well as working with jurisdictions, the ISSB works with other organisations that develop sustainability disclosure requirements. Now, we've already mentioned some of them, so I'm only going to point to two here. First of all, ISSB works with the Greenhouse Gas Protocol team because the Greenhouse Gas Protocol is the one required for the calculation of greenhouse gas emissions. And ISSB works with them both in technical terms, but also in terms of governance arrangements. So they work closely together. The other one to mention is the Task Force on Nature-Related Financial Disclosures. Now, if you sign up to follow the news on the ISSB website, you'll see that this is a current focus of ISSB's work. They're looking at introducing a practice statement on nature-related financial disclosures, which could draw upon the Task Force on Nature-Related Financial Disclosures work. As I said earlier, the ISSB also work closely with the GRI to make sure that common disclosures are aligned as possible. The important thing to note here is that in June 2025, the GRI's standard setting board granted equivalence to IFRS S2 for scope 1, 2, and 3 greenhouse gas emissions calculation and disclosure. So what this means is that information only really needs to be prepared once. Now, in order to use the equivalent IFRS S2 GHG emission disclosures, organisations reporting in accordance with or reference to the GRI standards will have to measure their greenhouse gas emissions in accordance with the Greenhouse Gas Protocol we just mentioned, and include a reference to the location where the information for each of the disclosures can be found according to the GRI content index requirement. As well as that, there's also a cooperation on using the GRI's biodiversity standard in developing the ISSB's work on nature-related financial disclosure of biodiversity ecosystems and ecosystem services. And there are some governance arrangements between the two organisations as well, including the fact that IFRS Foundation was a convening partner of the GRI's Sustainability Innovation Lab. Now, I'm not going to cover the relationship with the European standards reporting organisation, just because I suspect that's not so relevant to this audience. Some of you are using integrated reporting. We saw from the Zoom poll earlier, but the only thing I want to mention here is that you can use the integrated reporting framework as a complementary tool to support your disclosure under IFRS S1 and S2. There's a document we link to here which can explain how to do that. But perhaps the most important thing to say about integrated reporting is that it's underpinned by integrated thinking, and this can enhance the quality of a company's corporate governance. We're just going to do one more Zoom poll now before we go to the Module 2 summary, and I think you can only answer one here. Your reporting should consider the ISSB standards only, or the ISSB standards and regulatory requirements, or just regulatory requirements, or all of the above. I can see from the way the Zoom poll is progressing that you all know the answer to this already. So for time, I am going to end the poll and share the results with you here. Of course, it is all of those. Your reporting should take account of the ISSB standards, regulatory requirements, and other sources of guidance. So well done for answering that correctly. And we'll hand over to Fiona for the Module 2 summary now.
Thanks, Lois. So that brings us to the end of our second module. I think I mentioned this at the start, but the second module was a big one, we know, because there was a lot to cover in terms of the core content areas of the standards themselves. But don't worry, we're well more than halfway through the training, so well done for getting with us this far. But to wrap up a little bit on what we covered in this module, as I said, we walked through each of those 4 core content areas of the ISSB standards. So that's governance, strategy, risk management, and metrics and targets. So hopefully you've now got a better idea of what the particular disclosure requirements are within each of those areas. And we saw some examples as well of how companies are approaching those already. But an important thing I think to remember about these content areas is that they don't operate in silos. And we saw that in the examples that we discussed, that despite them being perhaps 4 separate categories of disclosure, in practice, they're all interconnected. So really making sure that you connect information across those aspects of your disclosure is a key consideration as well. And then we also then talked about how your disclosures could go beyond the requirements of S1 and S2. For example, to meet the needs of different stakeholders or to meet regulatory requirements in certain jurisdictions or also regulatory, industry standards or frameworks as well that Lois just talked us through. And so what's important to remember when you're doing this is that the ISSB standards have been purposely developed to act as a baseline. And so that building blocks approach would allow a report preparer to add additional disclosures on top. But in doing so, you do need to be careful not to obscure the requirements of S1 and S2 as well. So making sure that you're being clear on the baseline, and then you're kind of adding additional disclosures on top in a structured way if you need to. And there's various mapping documents available in the slide presentation that can support you in looking at this topic on a few different issues. Oh, flick our slide back. Great, so that summarizes this module, and let's just wrap up again with a discussion exercise in Menti. So we've heard there about a lot of different content requirements, and I'm sure the questions popping into your mind are likely to be about how well your current reporting aligns with these content requirements, and maybe thinking already about some of the gaps or improvements you might want to make to enhance your reporting to align with the standards. So we'll take a moment now to reflect on this together. But overall, what we'd recommend doing, of course, to support this is to go away and to conduct a more structured gap assessment. So it's just to say there is a simplified checklist. Oh, can I just ask people to be careful with the slides? Sorry about that, everyone. We'll go back a couple, I think. There we are. So as I was mentioning, there is a checklist that you can find in the homework sheet, which is designed to help you do a high-level gap assessment. But the sorts of things that we'd encourage you to think about when you're conducting a gap assessment would be to think about what particular content areas or disclosures you might need to build into your reporting to align with the standards. And also perhaps what types of processes, resources, skill sets you may need to implement, develop, or adapt to meet the requirements as well. So kind of 2 key areas there, the content and the information side of things, and also the process side of how you should approach that internally. So we're going to go back to Menti now to have a think about that question, which is what are the key gaps that you need to address in your current disclosures or internal processes? So as I've said, I'm sure there are many that come to mind. You don't have to share everything now, but it's just a good way to get us all thinking about this question together and seeing what's front of mind. So I have put the QR code back on the screen there. Sorry that I forgot to do that on our last exercise, but you can scan that QR code there on the side of the screen if you want to access the Mentimeter that way. I see many of you in Menti. Let's see, we've got 700 of you in Menti, 30 responded here so far. We won't have time to go through 700 answers, but let's definitely have a little bit of a look together whilst those of you who are still thinking are putting in your response. So let's see some of the things that are being mentioned here. Someone has mentioned that the gaps are mainly around the IFRS S1 disclosure and how they can link all of the materiality to financial disclosure. Yeah, absolutely. You know, for many organizations, that interconnectivity with financial reporting is perhaps an improvement area relative to previous sustainability reporting. So hopefully, you know, the fact that the standards are closely aligned with accounting concepts provides you with a running start line there, but definitely making sure there's a close relationship between whoever is preparing the reporting and financial accounting teams in your organization to explore and make sure those interconnectivities are there is a good idea. Let's see what else we've got mentioned. See on the right-hand side here, someone is mentioning sort of some of the climate elements around climate scenario analysis and transition and physical risks. So perhaps the S2 elements being more new to you there. Again, I think that's something we hear many organizations talking about is, you know, the technical aspects of getting to grips with those aspects for climate. So encourage you to look at some of the resources we've shared here in the chat and in the slide presentation, which give you some takeaway resources to look at some of those climate specifics in more detail. See what else we've got. Someone is mentioning around data here, so data availability, data accuracy, and data assurance. So yeah, I guess really pushing from that qualitative information to quantitative data-based disclosures, and making sure, as you say, that those are collated and reported in a way that is at a standard that could be assured if you decide to do that. So definitely thinking about how to approach those controls to put in place, I think is an important thing here, so that you're really going about that data collection in the right way from the outset. See what else we've got. Lots of great answers already. Thank you, everyone. So let's see. Someone's mentioned about internal processes, alignment, and buy-in. Everyone's very busy with existing daily businesses to now focus on measuring and quantifying. Yeah, okay. That's also a very fair challenge, I think, that many on the call today, I'm sure, would resonate with. So I think, as a few people have mentioned, the reporting process can be very resource intensive. And of course, what we don't want to do is lead to that taking resource away that could be spent implementing measures as well. So I think what's really important engaging with your leadership team on this topic is being quite clear about the step change we're seeing here, and that actually sustainability reporting should be more seen on the level with financial accounting now. So if you think about the resources in your organization attributed to financial accounting, I'm imagining you have a whole team, maybe even a whole function or department dedicated to that topic. And whilst that may not be the position you get to in the immediate term on sustainability, it is a thing where, you know, you can't just have one person whose job it is perhaps to manage all of sustainability, including reporting and implementation now. This is very much, you know, a dedicated skill set. So I think building that case internally to evidence, you know, the requirements, the compliance need, the investor demand for this information, and the resource implications is important, so that you can really assign that dedicated resource to disclosure, who can then play that important role in coordinating this and bringing in the right stakeholders in the business to support them. Okay, let's see, what else have we got here? So financial quantification is coming up again. So I think that's also a fair challenge regarding how to connect and financially quantify things. We obviously talked through a few of the reliefs that exist in the standard to allow for transitions there, and the provision of quantitative data where required. But indeed, definitely something to build out, and focusing on those areas of key risk and opportunity that may comprise material information. Mention of scope 3 data as well. Indeed, for many organizations, they may have some familiarity with collecting their Scope 1 and Scope 2, but perhaps Scope 3 categories are a newer element. So there, just really starting out by mapping out your existing understanding of what emission sources you have, maybe gathering what data you might be able to access to help you to estimate those emissions, and building the level of accuracy, granularity over time with a real focus on, those key activities, because you'll probably find when you screen Scope 3 that not all categories are relevant for you. And if there are various relevant categories, there's likely to be a few key ones that comprise a large share of your emissions. For example, for many organizations, that's supply chain emissions. So focusing your efforts where the most significant impact can be made there. Great, loads of great answers here. I'm seeing a few mentions of risk in the same line here. So around risk management, around the risks and opportunity disclosure and managing them. So indeed, and I think this is an important area as well to connect in with your colleagues in risk management. So you may already be working with them, but making sure that they're aware of these requirements, that you're conducting any assessments that you're doing in alignment with your enterprise risk processes, and ideally seeking to embed what's needed for sustainability related risks and opportunities into that core enterprise risk process is definitely what we would recommend here. Fantastic. Well, there's so many responses again. Thank you everyone for sharing, and I hope it's a useful exercise just to reflect here on your key gaps. Of course, as I think you're seeing, one key thing here is that it's very natural that there are gaps, and this is a situation that all organizations are going to find themselves in. So as we said, we'd encourage you to take this away, consider doing a more structured gap analysis if you haven't done already, and really trying to prioritize those gaps. So there may be some that are quite significant to address ahead of your first disclosures, but perhaps there are other areas that are more the case that you could continue to improve and evolve over time as your reporting matures. So providing transparency in your disclosures about that state of play can also be a really helpful thing for your audience to understand, that you're aware of those gaps and that you're continuing to take action to address them. Great, thank you everyone again for that exercise. So I'll go back to the slides now and we'll be getting started on Module 3 with Lois.
Thank you, Fiona. I think I just need the slide control back, if that's okay. And we're going to be talking about implementation, the backbone of effective disclosure. So there'll be 3 parts to implementation, and this really, we've talked about what you need to disclose as set out in the 4 core content areas. We're going to move on here to look a bit more about practically how this is done in 3 parts. First of all, identifying sustainability related risks and opportunities. How do we do that? Secondly, how to evaluate different parts of the process, including scenario analysis. And third, how to integrate sustainability into your existing set of processes and practices to help with your disclosures. Let's look at identify first, how to identify sustainability related risks and opportunities. So as I said earlier, S1 asks companies to provide material information on all sustainability related risks and opportunities that could reasonably be expected to affect the company's prospects, and S2 sets out the requirements for climate. But what about risks and opportunities beyond climate? Well, S1 directs companies to sources of information to help them with the identification of risks and opportunities and information to disclose about them. So firstly, when identifying which sustainability-related risks and opportunities to report on beyond climate, S1 says that companies must consider the applicability of the SASB standards. Now, these are the sector-specific standards set by SASB, and they set out the disclosure topics and metrics that might apply more specifically to your industry. Then companies may also consider IFRS educational material on sustainability related risks and opportunities and the disclosure of material information. We've shared the link to that a number of times in the Q&A and the chat. You can look at the CDSB framework application guidance, which covers a range of topics, including biodiversity, forests, social matters, and climate. You could look at industry practices, perhaps set by the sector body to which you belong, and the materials of investor-focused standard setters, including, for example, the integrated reporting framework. Then, having considered which risks and opportunities you need to report on using these sources of guidance, the same sources of guidance can be used to determine what particular information you should report. But in addition, you can look at the GRI standards and the European Sustainability Reporting Standards. Now, we saw an example earlier of this, the CLP example, where they'd used SASB and GRI to identify what to report about their waste management and pollution. So they had done exactly what the standards recommend. Let's have a look now at an example from IALA about their risk identification process. Well, they've got a four-part process that starts in all cases with communication and consultation. So they communicate and discuss the risks, action plans, and management processes at various stages in this four-part process. It sort of underpins how they do their risk management. Their first step, though, is to establish the context within which to understand the risks and opportunities. So they look at internal and external factors that affect the risk landscape. Secondly, they assess the risk. They identify, analyze, and evaluate the risks that they see in the wider contextual landscape. Thirdly, they decide how to treat the risk. And finally, set out the monitoring and review processes. So this is the process that they use for risk identification and then management and monitoring. Let's have a look at another example now from a slightly different perspective. This is an extract from Nest's 2024 annual report. It's a company based in Finland that produces sustainable aviation fuel, renewable diesel and feedstock solutions for the chemical industry. So it's using science and technology to transform waste and other resources. Now, their way of identifying risks and opportunities refers to two different scenarios. First of all, the net zero world, which they consider both on a global basis and for the EU and North America. Now, they look at the scenario on these two different bases because some economies may take action at a faster pace than others. In both cases, they expect that action will be taken to limit greenhouse gas emissions to between 1.5 and 2 degrees. And in this case, in the net zero world, they anticipate opportunities because they are focused on the circular economy and transformation of waste into renewable fuels. So they can expand into new markets and sectors, for example. And they expect their supply of renewable and circular solutions to be supported by regulation and voluntary ambitions. Of course, they identify risk too, but they see opportunities in that scenario. They also look at what they call a compromised climate scenario, where they anticipate that climate action will be slow and global warming of 2.5 to 3 degrees is expected. Now, in this case, the risk is that the demand for their products will be constrained, although they see an opportunity to differentiate themselves for others by providing renewable and circular solutions. The other thing to point out here is that they give us a sense of the indicative financial impact, not in numbers, but whether it's positive or negative. And you can see that the most positive indicative financial impact is in the net zero world 2050, which we might expect from a provider of renewable and circular solutions. That's in alignment with that scenario. However, The ISSB standards recognise that identifying risks and opportunities can be challenging, and they therefore say that a company is only required to use all reasonable and supportable information available at the reporting date without undue cost or effort. What does this mean? Well, reasonable and supportable information is specific to the company, so it's not just generic, it applies specifically to the company concerned. It takes account of the external environment, and we saw that in the Ayala example in their step number 1, which did just that. It includes information about past events and current conditions. Of course, the company will be familiar with those, but also forecasts, and perhaps that's why we saw Nest using scenarios to take account of forecasts and scenarios. And in some cases, what's reasonable and supportable is set out in the IFRS sustainability disclosure standards. And furthermore, the standards say that the company requires preparers to use an approach that is commensurate with their skills, capabilities, and resources. So we're going to move on now to the second part of this module with Fiona.
Great, thanks, Lois. So yes, we're now moving on to look at the next element around evaluation. So once risks and opportunities are identified, then companies need to think about evaluating the financial effects of those risks and opportunities. And we know that this can often be perhaps one of the most daunting elements when first getting started. So here we're going to briefly review a few of the key concepts that can help you to get going with this. So to help investors understand a company's resilience against climate risk, S2 requires that they disclose information about the impacts of climate change on its strategy and business model. And it also asks companies for their financial and operational capacity to adjust or adapt over the short, medium, and long term. For example, you might want to test your company's resilience against a new regulation to limit certain high emissions activities, or perhaps your ability to respond to changing crop yields if there's more frequent extreme weather events. And this is where scenarios come in, and using climate scenarios to analyze how effects will be incurred for the company. So when we're introducing scenario analysis, it's important to remember that it doesn't ask you to predict the future. It's a tool to test your resilience against potential future events. So they're not predictions or forecasts, but just projections of what's a plausible possible future pathway. S2 doesn't specify which scenarios a company should use, but it requires that the company selects relevant scenarios and provides information about which it's selected, that it provides information about the assumptions used in the analysis. And alongside the S2 standard, there is guidance for companies to inform the approach to scenario analysis and the range of methods that might be used, from qualitative scenario narratives to more complex statistical modeling. But overall, companies are asked to use an approach that's commensurate with their circumstances and that uses all reasonable and supportable information available to the company at the reporting date without undue cost or effort. So let's have a little bit of a look now to zone out a bit and see how this could look in a disclosure context. So the disclosure example here comes from Nestle, the food and drinks company. And this is one of the visuals that they include in their non-financial statement to summarize the outputs of their climate scenario analysis. And here they're looking particularly at physical climate risk, and they're projecting out to 2040, based on an intermediate emission scenario, how yields of some of their key agricultural commodities that they rely on in their value chain could change. So we'll see they're expecting decreases in quite a lot of agricultural commodities. They're expecting some areas to potentially increase, some to stay the same. And so this shows really how they're thinking about the impacts of climate events in the future, both chronic and extreme events on their crop yields. And they go in the report alongside this to talk about how that might impact the prices of commodities, the reliability of their supply chain, and the measures that they're taking to get ahead of this issue. For example, thinking about resilience, product innovation, and investing in R&D as well. So just one example of what this could look like. I think a key thing that we see here is that it is, of course, very contextualized to the company's context. So the types of issues that you would wish to assess here, the scenarios that would use, would be highly dependent on the type of industry you operate in, the geographies you're in, and which type of risk you're looking to assess. But there's a lot of tools out there that can help you to select the right ones and use the right tools for your context. Now, when we're talking about anticipating the materiality of information relating to future events, we know that that can be particularly challenging. And so to help with making a determination of what's material and uncertainties, IFRS S1 provides a list of issues that can help with this determination. So you could really think about this as all of the different steps and information that's needed to come to this judgment. For example, companies should be considering low probability but high impact outcome events. And so any uncertainties relating to company cash flows in the future do need to be evaluated. An important point here is that this uncertainty does need to be reassessed each reporting period. So it's not a requirement that you redo the scenario analysis each time, because that can be done in line with your company's strategic planning cycles. But it is important that these particular uncertainties arising from the analysis continue to be evaluated and assessed to form part of that materiality judgment. Okay, great. Back over to you, Lois, for the final part of this module.
Thanks, Fiona. So this last part integrate is about how you develop new processes or adapt your existing processes to support sustainability disclosure. And the good news here is that you're likely to have a lot of processes and practices within your company that can help you. The sorts of considerations you might want to apply when considering whether the processes and systems you already have are sufficient or appropriate are to undertake a gap analysis to check for gaps in existing systems, to consider the suitability both of the processes you have for identifying sustainability related risks and opportunities, but also the types of criteria you use for prioritization. So sustainability risks, as we know, are more uncertain than other types of risks and happen over different time horizons. So in addition to things like probability and likelihood, you might want to consider incorporating into your existing processes prioritization criteria that take account of impact, vulnerability, and speed of onset. We've already seen in the examples, haven't we, that some companies link their risk management process to their controls process. So evaluate whether and to what extent existing internal controls can help with sustainability disclosure. Importantly, which contributors, which people, departments, experts have processes and expertise to contribute to sustainability disclosure. Think about the interconnections between different things like internal and external factors and how they affect the risk landscape and whether they need to be taken into account in your process development. And finally, what resources might you need to manage existing systems and processes or to develop new ones? Do you need to go through a change management process or a budget application process in order to update or change your systems and processes? Now, in your homework, we suggest as a voluntary activity that you develop a disclosure plan to help with your sustainability disclosure. Now, by developing a disclosure plan, this can be a standalone strategy for sustainability disclosure or part of a wider disclosure strategy that takes account of related matters on governance and finance, for example. What does it do? It allows your company to take control of your narrative. After all, the requirements ask about your strategy, your risks and opportunities, your targets, and so on and so forth. So it really enables you to focus on what your company is doing rather than generic disclosures. It supports internal collaboration, knowledge sharing, and cross-functional team discussions because a disclosure plan would set out who would be involved in developing disclosures. Would it be risk management, company secretarial, procurement, finance? How will those individuals and departments be organized? What will their responsibilities be? Who will they report to? And so on and so forth. Plan can cover lots of other different things as well. How will data be sourced? Can you use existing systems and controls? What about assurance? What about sign-off, etc.? So most importantly, I think this disclosure plan gives you a central reference point and an audit trail for how your sustainability disclosures are to be developed, including where and how judgments have been made about matters of uncertainty. You can record all of these things, and you can imagine doing this before you get started on the reporting year is much more helpful than trying to do it during the reporting year. We'll look at an example from Novo Nordisk, which is a Danish pharmaceutical company. Sorry, the writing's quite small, but I'll explain what they're saying here is they're referring to the regulations, standards and practices that they have had to or have chosen to use for developing their disclosures. So they refer to some of the laws that apply to them, the Danish Financial Statement Act, for example, but also the frameworks they've used, the Greenhouse Gas Protocol, the Science-Based Targets Initiative, the Global Reporting Initiative, and so on. They list everything that they've used. They explain the time horizons that have been taken into consideration for the preparation of their sustainability statement, and they actually define how they, what they mean when they say short, medium, and long term. They explain how estimates have been used and where to find more information about assumptions and uncertainties, and there's lots of other contextual information to help readers understand the data. So you can see that for a reader thinking, I wonder how they've done that, there's a lot of information to help in this basis for preparation, which sets out many of the things that we would expect to see in a disclosure plan. So let's look at another Zoom poll now. And the question is a disclosure plan required by the IFRS sustainability disclosure standards? You can only answer yes or no. It's either yes, and you must disclose your plan, or no, but it's a very helpful tool. What do you think? I'll give you a minute more to think about this. We're a bit more on time now. I'm going to end the poll and share the results. Now, this is really, I would say, the most tricky Zoom poll question we ever have. And you've answered very much like other audiences that we have the pleasure of speaking with. And as 51% of you have said yes, and 49% of you have said no. The correct answer is no. There is nothing in the ISSB standards that says you must have a disclosure plan and you must give us information about it. Now, there are particular requirements that say that you must set out the basis on which you have prepared information. So if you don't use the Greenhouse Gas Protocol, for example, you must explain how you've set out how you've prepared your greenhouse gas emissions disclosures. And there are other specific requirements that say that you must set out how you have prepared your information, but there is no overall requirement to have a general disclosure plan. We're just suggesting you have it because we think it can be very helpful for you as you go through your disclosure preparation. Just got one more Zoom poll now, be a quick one, and I think you'll all know the answers to this. So select all that apply. A disclosure plan can help you to take control of your narrative, support collaboration, act as a reference point and audit trail for disclosure preparation, and skip full disclosure as required by the ISSB. thank you all for responding and for your great questions, by the way. You all know the answer to this, so I'm going to share the results. Yes, of course, it's the first three that a disclosure plan helps with, and it's not to be used as an excuse to skip full disclosure as prescribed by the ISSB. So well done for answering correctly there. And Fiona's going to take us through a summary of Module 3 now.
Thanks, Lois. Great. So, yeah, to the end of Module 3 now. So we're doing well moving through the content. So well done, everyone. And thanks for all of the continued engagement. We love getting so many questions, keeps us nice and busy in the session, and also the participation in your exercises as well. So big thank you. So to wrap up this module, we're just going to recap a few key things. So firstly, we'll come back to connections. So last time in module 2, if you remember, we talked about the connection between different content areas. And then in this module, we were really talking about the connections between a company and its external and internal environment. And really those connections are what we should be focusing on when we're looking to identify key risks and opportunities. Another thing we talked about here was the evaluation of risks and opportunities and the use of scenario analysis to support those evaluations. I think a key takeaway here is that the assumptions that you use are an important thing to disclose and to be consistent on in the way that you use this information. Of course, scenario analysis is a whole topic in of itself. There's loads of resources you can find online to support you in this topic. But if you're new to it, making use of some of the pre-packaged scenarios that are available, such as ones from the IPCC and the NGFS, can be very helpful. There's a number of resources dedicated to supporting companies on this topic as well. You can find a response on this in our FAQ database, which we've linked in the chat, which can be helpful too. And so the final thing that we'd highlight here is really around, even if some of this data might not be data that you're yet disclosing, it could be that you're already collecting it internally, or perhaps you may have appropriate practices or processes in place that could allow you to collect it. So as much as you can, building on what you already have, making slight adjustments and trying not to start from scratch is what we would recommend. So with that thought in mind, that brings us to the exercise for this module, where we're going to think a little bit about how we would go about addressing some of the gaps we've talked about, perhaps in particular data and content gaps, by using our existing systems, processes, and collecting data. So the element here of your kind of disclosure plan that you'd be looking to build out is really mapping what data you need, what teams need to be involved, and thinking about how you can integrate these requirements into existing organizational processes. And so that brings us to the Menti question, asking you, what are the existing processes and systems that you have that you could adapt to support you in collecting the information that you need for sustainability disclosures? So let's have a little bit of a look. I see many of you already responding to this. Thanks again. So let's see. I think the purpose of this exercise, I think, is really to show that there is a lot that you will have within your organizations already that you can build off here. And hopefully we can crowdsource some ideas together. So someone is mentioning health, safety, and environmental reporting. Someone's mentioning operational, procurement, financial, HR, and compliance processes. So yeah, lots of good systems indeed that will have very relevant things. Someone's mentioning utility bills with corporate real estate, maybe for energy usage and calculating emissions. Yeah, very good idea. Someone has said looking at data from other functions as well, HR. I think I see a few similar ones mentioned. Someone has said around energy again and electricity, lots of sources of information to support greenhouse gas emissions here. Thank you for that. Someone has also said about how you could automate and use software to help with data collection from multiple data owners. Yeah, absolutely. That can be a very good idea. There are many different reporting softwares out there as well, some particularly designed for sustainability, which can be worth considering. You might also want to review what software you're already using to collect financial or operational data. Maybe there are modules that could be integrated into that software for these topics, or maybe it could in other way be adapted to support this and used as well. Great. Risk management process has been mentioned as well. Yeah, definitely an important process to consider here to adapt to be assessing sustainability related risks and opportunities, and indeed to give you a source of information to include in your disclosures. Great, lots of great ideas already. Thank you, everyone. Someone was mentioning manual collection. Yeah, maybe if you're a smaller organization or you're just getting started, that can be a good place to start. You may want to start to move towards automating and kind of process building over time. But indeed, if this is the first time you're working on this topic, that may be what you need to start with to map things out. Great. Lots of different platforms being mentioned, maybe some particular systems that people are using in their companies. So thanks for sharing those, and names that others could take away to have a look at here. Great. And people are mentioning ERP systems as well, absolutely. And those will have the right types of controls and structures to them to make sure that you're collecting your data in a robust fashion as well. So lots of great ideas. I think you grasp the point well here that there is a lot that you'll be able to draw from. So encourage you to really think about it in that sense. Try not to think about this as something separate and new, but something that can really build on what you already have in place as much as possible. Great. Okay, so that brings us to our final module now. You may be happy to hear we're coming towards the end of our training. We've got an important section to cover as we finish off on communications. I'll just give you slide control, Bella, and I'll pass back to you for this.
Thank you so much, Fiona. Yes, good news is we're now on to the final unit of the training that focuses on the when and where in terms of disclosing sustainability-related financial information. Yes, as with the last unit, we'll cover this in three main sections, those being location, timing, efficiency, and confidence. So to get us started, let's talking about location. And in this section, we are looking to clarify where sustainability disclosures should be located. Okay. So before diving into the specific requirements of the SSB standards, it's maybe helpful to think about sustainability disclosures in the context of a complete reporting package that is useful to investors. As previously mentioned, the requirements in the SSB standards are based on addressing the information needs of investors and effectively build on past standards and frameworks, such as the TCFD and the SASB, which was similarly focused on investor information needs. One of the major advancements that the SSB standards bring is the rigor of accounting and the focus on connectivity to the financial statements. So while the SSB and the GRI standards do share some content requirements, they differ in terms of the overall objectives. So the SSB standards are really focused on investors' information needs and decision-making. That is information about sustainability-related risks and opportunities that could reasonably be expected to affect a company's cash flows, access to finance, or cost of capital. In comparison, the objective of GRI standards is to elicit information about a company's impacts, regardless of whether or not this impact a company's financial performance. So as a result, the SSB and the GRI take complementary approaches to materiality. And in practice, the GRI approach is more commonly understood among sustainability practitioners, while the IFRS approach is more likely to be familiar to accounting professionals and finance executives. So in summary, many of the impacts traditionally identified as material in the GRI standards may give rise to sustainability-related risks and opportunities that are likely to affect a company's prospects, and therefore investors would need information about them. You can also find some additional information about potential areas of focus for primary users, that is investors, in your handout. So now we move on to materiality. You'll probably come across various references to different types of materiality based on different reporting standards and frameworks. So it's helpful to briefly recap here what we mean by material information when it comes to the SSB standards. So as we discussed in the first module, information is material when it influences decisions of primary users of general purpose financial reports. In other words, investors, and informs their decisions about things like providing resources to a particular company, buying, selling, or holding equity or debt instruments, granting loans and other forms of credit, as well as voting on or influencing how management uses a company's economic resources. In this context, when preparing disclosures, the key consideration here is the characteristics of the investors and the company's own circumstances. So what do I mean by that? For example, different investors can have different and sometimes conflicting information needs, and therefore the intent of sustainability-related financial disclosures under the SSB standards is really to meet the common information needs of investors. And this is really about the key information that an average investor would be looking for. The important thing to remember is that materiality is a characteristic of information, and the SSB standards take a two-level approach to this. First, the identification of sustainability-related risks and opportunities that is based on what would investors expect to affect the company's prospects. And the next level is about what is material information, about those risks and opportunities which investors need in order to make decisions. Okay. Now, when it comes to disclosing material information under the SSB standards, S1 requires that material information be clearly identifiable and that the information itself is clear and concise. And what this really means in practice is that material information shouldn't be obscured by other non-material information. For example, by information that a company discloses on the basis of, say, another framework that is not centered on the information needs of investors, but maybe focuses more broadly and includes different types of stakeholders. And why this is important? The location of sustainability-related financial information within general purpose financial reports might vary between companies across different jurisdictions. And second, information designed to meet the needs of other stakeholders, beyond investors, might be provided voluntarily or to meet regulatory requirements. And the potential problem here is that material information reported under SSB standards could be obscured because it might be buried among other information that has been prepared for different purposes or according to different objectives that do not necessarily align with the SSB requirements. This could also be problematic in cases where reports are perhaps poorly organized in terms of content, and therefore material information is scattered throughout the report. And again, this is important because a company won't be able to assert compliance with the SSB standards if a report is overloaded with irrelevant data, or if it blends information for different audiences without clearly identifying the information that is material for investors. As mentioned previously, the IFRS Foundation has published educational material back in 2024 on this topic to really help provide additional guidance for companies on identifying and disclosing material information. So do check this out for additional detail by following the link in your handout. Okay, so I think it's time for a Zoom poll 11. Okay. So the question is, information should be disclosed in the annual report when applying SSB standards if admitting that information could reasonably be expected to influence investors' decisions, or if it could reasonably be expected to affect the entity's cash flows, or it exemplifies the values of the leadership team. Okay. So let's wait for a few more seconds to get more participants. Okay. Yeah. So I'm going to end the Zoom pool now and share the results. Okay, so I think you can see the results now. Yes, the correct answer are the first two. I mean option A and option B. So remember the definition of materiality or material information is information that if omitted, misstated, or obscured could reasonably be expected to affect investor decision making. So for this question, option A and option B are the correct answers. And for option C, unless it has been determined that particular values being exemplified are expected to have a financial effect on the company, which means will influence the investor decision making, this may not be information that is necessary. Okay. So let's continue with the slides. Yes. So returning now to the topic of location and where to report disclosures under the SSB standards, the standards must be made available at the same time and on the same terms as the financial statements. That is, as part of the same general purpose financial reporting package. So which means IFRS S1 doesn't have requirements that specify the exact placement of that information. And this just means that SSB standards do not specify where within that overall reporting package the information has to be provided. And that's really by design in order to give some flexibility and accommodate jurisdiction-specific requirements on the location of reporting. The most important factor to consider here is to ensure that sustainability disclosures are for the same reporting entity as the related financial statements. And again, that they are disclosed at the same time as the financial statements, covering the same reporting period. And it's worth noting that standalone sustainability reports are not prohibited by the SSB standards, provided that the report forms part of the general purpose financial reporting package. For example, a company might choose to have a distinct sustainability report that is issued alongside of a broader annual reporting package. And in practice, this is where the use of cross-referencing plays a really important role. And that is the cross-referenced information must be available on the same terms and at the same time as the sustainability-related financial disclosures, as I've already mentioned. And importantly, the complete set of disclosures mustn't be made less understandable by including information by cross-reference. And the cross-referenced information also becomes part of the complete set of disclosures made under SSB and must comply with all the SSB requirements, including things like being relevant, comparable, verifiable, and timely, etc. And to get a better idea of what this looks like in practice, I think we can see an example in the next slide. So over to you, Lois, for example.
Yes, thanks, Bella. Sorry for the hesitation. I was just wondering if Tiffany was going to do that one. But yes, we haven't got a company example here. What we have is the result of a study by WBCSD about different reporting practices across different jurisdictions. So what you'll see is that in 2025, standalone sustainability reports remain the predominant approach, comprising 54% of the reports in the sample that was considered for this study. However, bear in mind that that's gone down from 2023 when it was 62%. So what you're seeing here is a shift away from standalone reports, and possibly this is because of regulatory developments in different jurisdictions where there's a shift towards more connectivity between financial and non-financial reporting. At the bottom of the screen, you can see the study by reference to regions. So in the Americas, standalone reports really do predominate, representing 81% of reports. In APAC, there's a mix of sustainability and sort of self-declared integrated reports at 58%, and in EMEA we see lower at 39%. So certainly a trend here away from standalone sustainability reporting generally, but of course these presuppose that we're using PDFs. But there's moves towards digital reporting, which Bella is going to explain to us now.
Okay, thank you. Thank you, Lois. Yes, so let's continue with the slides. Now let's briefly talk about the evolution to digital reporting and the SSB taxonomy that you may have heard about. So in general, the term taxonomy is really just a general word for a classification system, and often times companies will have their own internal taxonomies that essentially help to define key terms across businesses or functions. So you may have also come across a reference to a taxonomy in the context of sustainable finance taxonomies, such as the EU taxonomy, but also a growing number of countries that have developed green taxonomies. And these are often called components of a broader sustainable finance framework. And what these taxonomies do is that they essentially help to classify different types of economic activity or investment as sustainable. Now, in comparison, when we talk about the ISSB taxonomy, we are actually referring to something different. It still means a type of classification system, but it refers to one that is used to categorize information within a report. And in this world of AI and the push for digitization, you've probably seen a shift or transition away from traditional PDF forms and increasingly towards information on web pages contained within structured datasets, such as datasets that are offered by stock exchanges or regulators. So recognizing this digital shift, to speak, the IFRS Foundation has developed the ISSB taxonomy, which is essentially a machine-readable digital tagging system published in April 2024 with the overall intent to help investors analyze sustainability reports. And the taxonomy does this by essentially translating the requirements of S1 and S2 into standardized data tags, which facilitates digital reporting and makes it easier for investor and data platforms alike to take larger data sets. Now, the SSB taxonomy is not mandatory for compliance with the SSB standards, but rather the taxonomy is designed to support the digital submission of SSB disclosures, which comes with a few benefits. Okay, so let's continue with the second session. So following the discussion on location and the timing, we wanted to spend a little time talking about the efficiency. Yeah. Okay. Okay. So what does effective communication actually mean, and what does it look like? Often companies think that if they just put all the information that they have into a report, then they've covered everything and everyone will be satisfied. However, when you think about SSB standards, remember that a core conceptual foundation of S1 is fair presentation, which means that a complete set of sustainability-related financial disclosures under SSB should present fairly all sustainability-related risks and opportunities that could reasonably be expected to affect an entity's prospects. So it's not about putting everything about sustainability into a report. It's about presenting material information. And the S1 also requires information to be clear and concise. And the clearest form that a disclosure can take will obviously depend on the nature of the information. So this might include, for example, the use of tables, graphs, or even diagrams with the accompanying text. And in terms of being concise, this really means that companies should avoid unnecessary duplication, use clear language, and avoid boilerplate information. Okay. When talking about the quality of information to report and how traditionally the disclosure of sustainability information and financial information has been a bit different. So accountants in the audience are probably very familiar with the rigor that is required when it comes to data collection, oversight, sign-off, and even external assurance that is associated with the preparation and disclosure of general purpose financial reports. And this whole concept of a very strong internal control environment is really well understood. In comparison, sustainability information has not traditionally been prepared under the same type of control environment. And because of this, the SSB standards really do focus on elements of quality. So for example, through requirements related to providing comparative information from the previous reporting period, as well as requirements that deal with restatements and the need to restate comparative information or amounts for prior periods disclosed in the case of material error. And again, focusing on quality, companies should also avoid unnecessary duplication and can achieve this through the use of cross-referencing. So the last thing regarding the aggregation. So when aggregating information should be aggregated if it has shared characteristics and disaggregated if not. And this is really about ensuring material information is not obscured, such that information shouldn't be aggregated if doing so would obscure material information. So let's spend a few seconds on cross-referencing. So there may appear to be some overlap in this topics covered and the information disclosed across different reports and sections of reports. So in fact, S1 actually requires companies to avoid unnecessary duplication. So for example, if a company has the same governance approach for all sustainability issues, then this information would only need to be disclosed once. Or if information required by the SSB standards is in another report that a company publishes, then the company can include material information in its SSB disclosures by cross-reference. But cross-referencing is only allowed provided the other report is available on the same terms and at the same time. So I think we have another example. So over to Louise. Yeah.
Thanks, Bella. We're actually going to skip the detail on this example because we're running so short on time. The only thing to mention is that all of where the content elements of the IFRS are set out in the left-hand column, and in the right-hand column, the company tells us where we find information about those things. So back to you, Bella.
Yes, thank you, Lois. Okay, so oh, okay. Maybe we can okay. So
Thanks. I'll just
we
flag up the time, so we might need to skip a couple of things.
okay, sure. So maybe we can skip the Zoom poll. Yeah.
Sure.
Okay, so here mechanism that support adoption. Yes, I just want to briefly mention that the proportionality mechanism in this section. So many requirements in S1 and S2 are to be applied proportionately, which again recognize that companies will have a range of capabilities and preparedness on these issues. So for example, qualitative scenario analysis is permitted, and you will see the phrase all reasonable and supportable information as at the reporting date without undue cost or effort, all commensurate with skills, capabilities, and resources in a number of places. So I just remember that maybe some of the questions in this session asked regarding the proportionality. So I think I recommend you find some time to read out the handout or read the standards to better understand this mechanism. So in light of the time, so we are going to skip these two Zoom polls, and it's really easy for all of you, I believe. Okay, so let's come to the last session, confidence. Okay, so an important trust builder is showing data and chance over time, and as such, as one requires that companies disclose comparative information for the preceding period for all amounts disclosed. And so, why is comparative information so important? It really helps to emphasize context and also allows companies to demonstrate relative progress over time, as well as communicating changes or evolutions to a company's strategy and risk management processes. And occasionally, a company's sustainability disclosures may well contain material errors, and in this situation, a company is required to restate these errors in the comparatives provided. And just to note that revisions or restatements are only necessary when there is a risk of material information being omitted, misstated, or obscured because of not revising or restating the comparatives. Okay, so finally, it's important to build confidence by providing clear statements of compliance. And in fact, a company that complies with all of the requirements in the ISSB standards is required to make an explicit statement of compliance. And it's important to emphasize that a company can still make a statement of compliance if it has decided to make use of specified transition reliefs in the first year of ISSB reporting, or if the company is using any of the proportionality mechanisms. So there are also two exemptions where information required by the ISSB standards could be omitted that would still allow a company to make a statement of compliance. These exceptions are the first one is commercially sensitive information. The second is when law or regulation prohibits disclosures. So I would also recommend that you read the standards or any related materials for details regarding a statement of compliance and also the two sections. Okay, so it's time for things to remember, and this is the summary of what we have learned for this session. So I'm going to skip these slides, and back to Fiona for summary.
Thanks very much, Bella, and appreciate your flexibility to move through some of that content quite quickly. As a quick reminder, everyone, this slide handout is available for you to download from the event webpage for today's session, which we shared the link to a number of times in the chat and Q&A. So any slides that we didn't cover in any detail, you're welcome to pick those up and review them in the handout. There's also a few extra slides available in the handout with extra examples and context, so do recommend checking that out for some extra materials. But to bring us to a close and wrap up on our final module, you'll be pleased to hear, we'll go through a few key takeaways, some resources that you can take away, and of course, some important points relating to your certificates, etc. So just to wrap up on what we learned in this module. So firstly, we discussed where to report information. And I think what was really important here was the audience, or who you're reporting to. So being sure to be clear from the start who the primary user of information is really going to help to ensure that that information is really right for their needs. And then we talked about efficiency. And I think the key takeaway there is that less is more. So the objective isn't to overload your investors with information, because actually that could be harmful and potentially obscure information that is required. So this is where using the standards as you get started can be a good guide to make sure that you're providing what information investors need, which is, of course, overall the purpose of the ISSB standards. And then finally, we talked about report user confidence. Now, especially in the current climate of potential greenwashing accusations and legal battles over public statements, it's more important than ever to ensure that your data is not only accurate, but that it's presented in a way that builds confidence among report users. So that's where the disclosure plan that we've been discussing can help you to do this, because if you build out your disclosure plan well, then you're going to have a clear and documented process for reporting the data that investors really want to see. Great, so in the interest of time, we're just going to skip our final exercise on navigation techniques, but I will ask you just to return to Menti for one final time, because we'd like to revisit that question that we asked you at the start of the session regarding how comfortable you were with the different tasks that we set out to work on together today in the training session. So let's just take a quick look at your answers to this question. And we do appreciate your response to this question, just so that we know how effective our training is and any areas perhaps we can continue to develop. So it looks like for those of you who've responded so far, I know we were somewhere about 2.5 maybe on average in terms of your comfort with the different tasks at the start of the session. We're still somewhere in the middle of the scale, but it's a higher number in the 3s, so that's good to see. But if you haven't voted already, do please vote and let us know. And I'll leave that question available in Menti for you to respond to in the background. But whilst you're doing that, I'll just take us back to the slides to look at a final few points together. So one of these is just to talk about the homework exercise, which I've mentioned throughout the training. So the homework exercise is structured in the same way as those interactive exercises we've done together today, but really designed to help you build your thinking out on those areas and put forward a reporting plan that you can use within your organization. So you can download that homework from the bottom of the event page, which has been shared by Lois in the chat just now. At the bottom of that page, you'll find the link to the homework. As we've said before, this isn't mandatory to complete, and it's not necessary to submit this to us in any way, but it's really just designed to support you in continuing to learn and take forward this topic with your colleagues. So do encourage you to take a look at that if you're interested. Okay, and then just to wrap up with a few key resources to mention from all of our organisations before we get on to the important question of the feedback survey and your certificates. So firstly, one great resource to make sure that you have saved is the IFRS Knowledge Hub. This is regularly updated with relevant resources and includes many of the materials we've talked about from IFRS today, so be sure to check that out. The IFRS has also launched 4 free e-learning modules to support adoption of the standards, which are self-paced, interactive knowledge checks, which also offer CPD certificates. So recommend checking out those e-learning courses. You can find those on the Knowledge Hub, or you can access the link in the slide here as well. And a few other key initiatives to be aware of from the IFRS Foundation. Firstly, the potential to take the FSA credential qualification, a more in-depth course related to the ISSB standards, and really a way of demonstrating your expertise on this topic. So be sure to check out the link to that. And then more information. I know licensing came up a couple of times in the chat, so you can refer to more details about licensing on this page as well, linked in this slide. A few key resources. We had Lopa from IFC join us at the beginning of the session. She mentioned the Beyond the Balance Sheet program. So there's a slide here from the IFC summarizing this resource, and you can find the links here. A great set of resources across all forms of disclosure and sustainable finance topics. We've already told you about the SSE's toolkit, so just a reminder here in the slides of the SSE toolkit resource as well. And then I want to make sure we've covered the most important point before we close the session, which is to say a big thank you for all of you who've taken the time to be with us in today's session and to participate. To get your certificate for taking part in the training, you will need to fill out the feedback survey. Lois has just shared it in the chat, but I might ask her to keep posting that message a few times, which I think she's doing because of the amount of you commenting, which is great to see. But do scroll up in the chat if you haven't seen that already. If you follow the link and complete the feedback survey there, we'll send the certificate to the email address you complete the survey at. We'll also send this email out 24 hours from now in an email from Zoom. So you'll get another chance to receive that link in the email that you'll get from Zoom as a participant. If you make sure to fill out the email address as one that you know is not too difficult to access in terms of spam, so perhaps a personal email address if your organization's firewalls are quite aggressive, we'll make sure that you do receive your certificate. So be sure to check your spam folder, but give us about a week to send out your certificate. And after that point, you can contact us if you're still missing your certificate. But lastly, I'd just like to close out with a few thank yous. Firstly, to the SSE supporters, a group of stock exchanges and wider organisations, including Bursa Malaysia, who help to make our work possible. Supporters can also be other advisory organisations as such. So if this is a programme you're interested to know more about and get involved in, you can contact the SSE at the details at the end of this presentation to find out more about this programme. We'd also like to thank our partners on this programme once again, so to the IFC and in particular the IFRS Foundation. So a big thank you to Bella for presenting for us today, and of course to Rebecca and Visvesh, who've been doing such a great job of responding to your many questions in the Q&A. So a big thank you to all of the IFRS team. And lastly, of course, a big thank you to our great partners at the Bursa Malaysia team, to Julian, to Arvin and team for all of your support to make today's session possible. As a reminder, we've shared the contact route to reach out to the Bursa Malaysia team in the chat with their email address if you've got any follow-up questions for them. But we'll close the session there. So all that is left for me to do is to say a big thank you once again to all of you for joining us today. We really appreciate all of your time and engagement on this topic. As a reminder, later this year, we'll also be conducting nature-related training in your market. So you can already register for that session on the SSE events page, and you'll hear more about that from the Bursa in due course. But thanks all, and wishing you a happy rest of your day.